In this presentation, we will discuss tax treatment of traditional IRAs, IRAs, individual retirement accounts, including deductions related to an individual retirement account. This will be a long presentation. If you would like to jump to relevant components within it, take a look at the description below, which will have links to those relevant components, as well as a description of what will be included within them. Much of this information will be found in publication 590A. You'll also find a link to publication 590A within the description below. In this presentation, we will discuss an introduction of the traditional IRA and a discussion of what is compensation with relation to the traditional IRA. This information can be found in publication 590A. Introduction. This chapter discusses the original IRA. In this publication, the original IRA, sometimes called an ordinary or regular IRA, is referred to as a traditional IRA. A traditional IRA is any IRA that isn't a Roth IRA or a simple IRA. The following are two advantages of the traditional IRA. So the main two advantages: you may be able to deduct some or all of your contributions to it depending on your circumstances, and generally amounts in your IRA, including earnings and gains, aren't taxed until they are distributed. These are the main two advantages, and when we think about a traditional IRA or an original IRA, we're thinking about the normal type of IRA. So it's in case or unless someone says something other, such as a Roth IRA or some other type of IRA, we're probably considering or thinking about a traditional IRA account. And that means the traditional IRA is the one where we're going to have on Schedule 1 a deduction. So we have the deduction of, in this case, in this example, $5,500, the maximum typically for a single individual. We'll talk more about those items later, but we'll have the deduction here, which will lower the income, lowering the adjusted gross income, allowing for the taxes to be lower as well. That's going to be one of the principal advantages. That's the one most people think of when you're thinking about an IRA, because you're typically thinking about how to save on tax dollars. In order to save on the tax dollars, you actually have to put a lot more money into the savings account or into some type of account under the IRA umbrella. There is another savings, of course, as well, and that is that the income in the IRA, remember, we're putting money into something that's going to be something like stocks and bonds, possibly a savings type of account. Any income, interest, dividends, and whatnot typically is not going to be taxed. And that's something that we're not as aware of most of the time. Most of us are very aware of the deduction we might get in the point that we put that money into an IRA. And we're not as aware because we don't receive documentation as formally or usually with regard to us not having to include the income in things like dividends or interest within investments under the IRA umbrella as we would if they were not under the IRA umbrella. And just remember that most of the investments, they're the same type of investments. If they weren't under the umbrella of an IRA, then we would be paying the taxes as they grow in value, in some cases, dividends and interest typically. But we wouldn't be paying those if they're within the IRA, and therefore we don't receive documentation. And those are benefits we often miss because they're not included on the tax return. They're benefits because we don't have to include on the tax return the income. And if we have to include the income, that means we're going to pay taxes on it possibly. If we don't include the income on the tax return, then clearly we're not calculating any tax on that income. Back to the text. What is compensation? Generally, compensation is what you earn from working. For a summary of what compensation does and doesn't include, see Table 1.1. Compensation includes all the following items discussed next. So think about, for the taxes, of course, when we're thinking about compensation or income, we're considering items that we typically have to include on the tax return for income and then potentially be taxed on. So from a tax perspective, we would like to not have to include it as income, not have to include it as income. In this case, we're specifying the compensation. So the question then, with regards to certain items in regards to things like an IRA, is when we think about income limitations and what types of earning limitations we might have, what qualifies as income, what qualifies as compensation. Now note, when you think about income for taxes, usually their general default setting is that something is income and therefore taxable, unless we, the government, the IRS, says otherwise. That's going to be kind of the general rule. So if we got income or something like that, usually it's going to be basically income unless there's some kind of reason that we don't have to include it in income. Here, talking compensation. Back to the text, wages, salary, etc. Wages, salary, tips, professional fees, bonuses, and other amounts you receive for providing personal services are compensation. The IRS treats as compensation any amount properly shown on Box 1, wages, tips, other compensations of Form W-2, wage and tax statement, provided that that amount is reduced by the amount properly shown in Box 11, non-qualified plans. So note, when we're thinking here, we're restricting to Box 1, or line 1, that's typically on Box 1 of the W-2, wages, salaries, tips, typically reported on the W-2. When you consider the W-2, there are usually 3 lines that relate to income, and that there's one related to Box 1, 3, and 5, I believe. And here's an example. So Box 1, 3, and 5, 1 is going to be the compensation that we usually consider with regard to federal income taxes. But note that Box 1 is going to be reduced by things that we don't have to include or is not taxable for federal income taxes. So this Box 1 typically is what we think of as being reported here on the 1040. However, that amount is not going to be including something that we may take out. For example, like a 401k type of plan might reduce what's in Box 1. Box 3 and 5 are also items that describe income with relation to Social Security for Box 3 and Medicare for Box 5. Box 5 is often the highest of the 3 boxes if they're different, because Medicare doesn't have as many things that can reduce it for the calculation of the Medicare tax. Back to the text. Scholarship and fellowship payments are compensation for IRA purposes only if shown in Box 1 of Form W-2. Commissions, an amount you receive that is percentage of profits or sales price, is compensation. Self-employment income. If you are self-employed, a sole proprietor, or partnership, compensation is the net earnings from your trade or business provided your personal services are a material income producing factor reduced by the total of the deduction for contributions made on your behalf to a retirement plan and the deduction allowed for the deductible part of your self-employment tax. So if we have our own business, we typically think of the Schedule C. The Schedule C will have income and loss, which will then flow through eventually to the 1040 as income as well. When considering the Schedule C, it may be the case that we have set up some other type of retirement account as well. So we'll have to consider the interplay between if we set up some other retirement account on the Schedule C or with our business with relation to any type of individual retirement accounts we might have. Back to the text. Compensation includes earnings from self-employment even if they aren't subject to self-employment tax because of your religious beliefs. Self-employment loss. If you have net loss from self-employment, don't subtract the loss from your salaries or wages when figuring your total compensation. So note that it's possible then to have a loss if we consider a loss on the net income for the Schedule C. If this number is negative, they're saying that normally it would pull over to the 1040 and it can reduce the taxable income on the 1040. But right here, we're considering the calculation with regard to the IRA. Back to the text. Alimony and separate maintenance. For IRA purposes, compensation includes any taxable alimony and separate maintenance payments you receive under a decree or divorce or separate maintenance. Non-taxable combat pay. If you were a member of the U.S. Armed Forces, compensation includes any non-taxable combat pay you receive. This amount should be reported on Box 12 of your 2018 Form W-2 with Code Q. Compensation for purposes of the IRA includes, we have the wages and salaries, commissions, self-employment income, alimony and separate maintenance, non-taxable combat pay. It does not include earnings and profits from property, interest and dividend income. And note, we're not talking about just income that you might have to pay taxes on, because some of these items, of course, may be considered income. we're considering with relation to the IRA. So if we go back over here, interest and dividends, those are typically going to be passive type of income. Pension and annuity income, deferred compensation, income from certain partnerships, any amounts you exclude from income. What isn't compensation? Compensation doesn't include any of the following items, and we just took a look at some of them in our table. These include earnings and profit from property such as rental income, interest income, dividend income. So these items, again, they could be included on the tax return. We're talking with relation to the IRA. These are usually considered more kind of passive income type of activities, and therefore when considering them with regard to some areas in the tax code, they might not be considered income or not like earned income or compensation in this case. Back to the text. Pension or annuity income, deferred compensation received, compensation payments postponed from a past year, income from a partnership for which you didn't provide services that are material income producing factor, Conservation Reserve Program, CRP payments reported on Schedule SE, Self-Employment Form 1040, Line 1B. Any amounts other than combat pay you exclude from income, such as foreign earned income and housing costs. In this presentation, we will discuss what's new and reminders with relation to IRAs, individual retirement accounts. This information can be found in Publication 590A. We're going to start off with what is new for individual retirement accounts because it's difficult to unlearn things. We want to make sure that if we have some notion of what the law is in the past, we first consider the new items so we can point those out and not have confusion and be able to reset our thinking in terms of what are the changes. Then we'll go into the detail and as to what the current law is related to these items and other items related to individual retirement accounts. Extended rollover period for qualified plan loan offsets in 2018 or later. For distributions made in tax years beginning after December 31st, 2017, you have until the due date, including extensions, for your tax return for the tax year in which the offset occurs to roll over a qualified plan loan offset amount. For more information, see time limit for making a rollover contribution. We will take a look at that in Chapter 1. No recharacterizations of conversions made in 2018 or later. A conversion is a traditional IRA to a Roth IRA and a rollover from any other eligible retirement plan to a Roth IRA made after December 31st, 2017 cannot be recharacterized as having been made to a traditional IRA. For more information, we'll take a look at recharacterizations. That'll be in Chapter 1. Modified adjusted gross income limit for traditional IRA contributions. For 2018, if you are covered by a retirement plan at work, your deduction for contributions to a traditional IRA is reduced, phased out, if your modified AGI is more than $101,000 but less than $121,000 for married couple filing a joint return or a qualified widower, more than $63,000 but less than $73,000 for a single individual or head of household, or less than $10,000 for a married individual filing a separate return. Modified adjusted gross income limit for certain married individuals. If you are married and your spouse is covered by a retirement plan at work and you aren't, and you live with your spouse or file a joint return, your deduction is phased out if your modified AGI is more than $189,000, up from $186,000 for 2017, but less than $199,000, up from $196,000 for 2017. If your modified AGI or adjusted gross income is $199,000 or more, you can't deduct a deduction for contributions to traditional IRAs. We'll get into some of these limitations in the modified adjusted gross income, what that means and what these phase outs mean, and the relationship between the IRAs and other types of retirement accounts we may have with our employers, such as a 401k type of account, how they interplay with each other, what are the how do they go together, and what are the restrictions with relation to them, in future presentations. Modified Adjusted Gross Income, AGI, limit for Roth IRA contributions. For 2018, your Roth IRA contribution limit is reduced, phased out in the following situations. Your filing status is married, filing jointly, or qualified widower, and your modified AGI, adjusted gross income, is less than $189,000. You can't make a Roth contribution if your modified AGI, adjusted gross income, is $199,000 or more. Your filing status is single, head of household, or married filing separately, and you didn't live with your spouse at any time in 2018, and your modified AGI, adjusted gross income, is at least $120,000. You can't make a Roth IRA contribution if your modified AGI, adjusted gross income, is $135,000 or more. Your filing status is married filing separately. You lived with your spouse at any time during the year, and your modified AGI, adjusted gross income, is more than 0. You can't make a Roth IRA contribution if your modified AGI, adjusted gross income, is $10,000 or more. Note, when we're considering the AGI and the modified AGI, what we're talking about is, if we take a look at our example 1040 here, the adjusted gross income typically is on line 7, or will be on line 7 of the 1040. Whenever you see anything in the tax code, or typically anything in the tax code that says adjusted or modified AGI, it means adjusted gross income line 7, modified for certain things that are specific to that particular area of the law. So if it says modified AGI, there may be some modifications to this number with specific relation to what we're talking about, in this case, IRAs or Roth IRAs. And many times those modifications are just kind of unusual type of situations or slight types of modifications and may not apply in all cases. And therefore, we're really talking about the income limitation. Many times when we consider the phase out, we're talking about, as income goes up, the amount of benefit we might get from some tax benefits such as deductions will be phased out as income goes up, and oftentimes the starting number for that income isn't, that phase out isn't total income, but adjusted gross income. And of course, the adjusted gross income, one of the things that confuses our topic now is that the IRA deduction is part of the adjusted gross income. So when we consider what adjusted gross income is with relation to a limitation for the IRA, we're going to have to consider the fact that the IRA is going to be part of the adjusted gross income calculation. Back to the text. What's new for 2019? Modified AGI, adjusted gross income limit for traditional IRA contributions increased for 2019. If you are covered by a retirement plan at work, your deduction for contributions to a traditional IRA is reduced, phased out if your modified adjusted gross income is more than $103,000 but less than $123,000 for married couple filing a joint return or a qualified widower, more than $64,000 but less than $74,000 for a single individual or head of household, or less than $10,000 for a married individual filing a separate return. Modified AGI, adjusting gross income limit for certain married individuals, increased. If you are married and your spouse is covered by a retirement plan at work and you aren't, and you live with your spouse or file a joint return, your deduction is phased out if your modified AGI, adjusted gross income, is more than $193,000, up from $189,000 for 2018, but less than $203,000, up from $199,000 for 2018. If your modified AGI, adjusted gross income, is $203,000 or more, you can't take a deduction for contributions to a traditional IRA. Modified AGI limit for Roth IRA contributions increased. For 2019, your Roth IRA contribution limit is reduced, phased out, in the following situations. Your filing status: married filing joint or qualified widower, and your modified AGI, adjusted gross income, is less than $193,000. You can't make a Roth IRA contribution if your modified AGI, adjusted gross income, is $203,000 or more. Your filing status is single, head of household, or married filing separately, and you didn't live with your spouse at any time in 2019, and your modified AGI, adjusted gross income, is at least $122,000. You can't make a Roth IRA contribution if your modified AGI, adjusted gross income, is $137,000 or more. Your filing status is married filing separately. You live with your spouse at any time during the year, and your modified AGI, adjusted gross income, is more than 0. You can't make a Roth contribution if your modified AGI is $10,000 or more. Reminders. Future developments. For the latest information about developments related to Pub 590A, such as legislation enacted after it was published, you can go to the IRS website, irs.gov/Pub 590A. Qualified disaster tax relief. Special rules provide for tax-favored withdrawals and repayments from certain retirement plans for taxpayers who suffered economic losses as a result of Hurricane Harvey or Tropical Storm Harvey, Hurricane Irma, Hurricane Maria, or the California wildfires. You can see Publication 976, Disaster Relief, for information on these special rules. Also, see the instructions for Form 8915B, Qualified 2017 Disaster Retirement Plan Distributions and Repayments, for more information on these new rules. Disaster tax relief is also available for taxpayers who suffered economic losses as a result of disasters declared by the President under Section 401 of the Robert T. Stanford Disaster Relief and Emergency Assistance Act during calendar year 2016. See Publication 976 and the instructions for 2016 and 2017 Form 8915A, Qualified 2016 Disaster Retirement Plan, Distribution and Repayment, for more information on these provisions. IRAs and unrelated business income. An IRA is subject to tax on unrelated business income if it carries on an unrelated trade or business. An unrelated trade or business means any trade or business regularly carried on by the IRA or by a partnership in which it is a member. For more information, see unrelated business income under what acts result in penalties or additional tax later. IRA interest. Although interest earned from the IRA is generally not taxed in the year earned, it isn't tax-exempt interest. Tax on your traditional IRA is generally deferred until you take a distribution. Don't report this interest on your return as tax-exempt interest. For more information on tax-exempt interest, see the instructions for your tax return. So just remember that when we put information or money into the IRA, it's usually in some type of investments. That investment might generate interest. Now, the interest isn't taxable. That's one of the benefits of it being in the IRA. So, however, we might be tempted to put it on the return as tax-exempt interest to report it. But tax-exempt interest, that's not where it goes. It's not tax-exempt. It's really tax-deferred, because we will be paying taxes on it, but it will be paid in the form of distributions or at the time of distributions, because we will be distributing both the interest and the principal, and both are going to be taxable at the point of distribution. So we don't want to include basically any earnings typically, including interest on the tax return, whether we say it be taxable or not. We don't want to report it because it's not exempt. We just don't generally report it until the point in time that we take the money out as a distribution. In this presentation, we will continue to discuss how can a traditional IRA be opened, this time concentrating on a individual retirement annuity. This information can be found in Publication 590A. Individual retirement annuity. You can open an individual retirement annuity by purchasing an annuity contract or an endowment contract from a life insurance company. We can think of an annuity as a type of investment. So remember our goal here. Our goal obviously is, one, to reduce our taxes by putting money into some type of account that's going to help us to save money up front on our current tax return. Well, where are we going to put it? We're going to have to save it somewhere for retirement. Well, usually we would think of as a savings account or possibly stocks and bonds. We can also think, well, what about something like an annuity? An annuity is something that we might put money in and could set up to give us some fixed amount of money in the future. So it pays back some kind of fixed amount of money in accordance with whatever calculation the annuity was in. Why is it the case that we might deal with it in insurance? Insurance companies, of course, deal with annuities all the time because they might deal with an annuity based on the life expectancy. In other words, we might try to set up some type of annuity so that we put money in now and we get a payment starting at some point, and you can imagine that we get that same payment until we die. And you might say, well, how do they know when you die? Well, they don't know when you're going to die, and therefore we have to do some actuarial kind of crazy math to figure out what those payments might be in accordance with annuity table. So different types of annuities can be set up, but those annuities typically are good at, the people that are good at those types of annuity calculations will be the insurance companies, and therefore the annuities is another kind of type of investment we can think about. What if I put money into an investment now, and then I set up an annuity so that the annuity will then pay me out a fixed amount, possibly until I die, possibly. Back to the text. An individual, and that's just one way we could set up the annuity. So that's just to think about the type of annuity that can be there, or what might an annuity be as compared to other types of investments like stocks, bonds, and putting money into the bank account. Back to the text. An individual retirement annuity must be issued in your name as the owner, and either you or your beneficiaries who survive you are the only ones who can receive the benefits or payments. An individual retirement annuity must meet all the following requirements. Your entire interest in the contract must be non-forfeitable. The contract must provide that you can't transfer any portion of it to any person other than the issuer. There must be a flexible premiums so that if your compensation changes, your payment can also change. This provision applies to contracts issued after November 6, 1978. The contract must provide that the contributions can't be more than the deductible amount for an IRA for the year, and that you must use any refunds premiums to pay for future premiums or to buy more benefits before the end of the calendar year after the year in which you receive the refund. Distributions. And so clearly you want to talk and get advice if you're going to set up the annuity. Make sure that you're in accordance with the regulations to set up the annuity properly within the regulations for an IRA. Back to the text. Distributions must begin by April 1st of the following the year in which you reach 70 and a half. So we have that same kind of situation where we have to have the distributions at 70 and a half, as we saw in prior presentations. Back to the text. See Pub 590B for more information about required minimum distributions and other distribution rules. In this presentation, we will discuss simple IRAs, simple IRAs. This information can be found in publication 590A. Simple IRAs. A simple IRA plan is a tax-favored retirement plan that certain small employers, including self-employed employees, can set up for benefit of their employees. Your participation in your employer's simple IRA plan doesn't prevent you from making contributions to a traditional or Roth IRA. You can see publication 560 for more information about simple IRAs. In other words, you might be working for a business, possibly a small business, that instead of having something like a 401k plan has a simple IRA plan. So we have a simple IRA plan that might be set up by a small business. You can think of that as comparison to if you're working for a larger business, they may have something like a 401k plan. If you had a 401k type plan, then and you contribute to it, any contributions you make to the 401k plan would typically be reflected on the W-2. It would be taken out of box 1 of the W-2, and therefore when you report it on your tax return, your tax reporting would be lower than it would have been than your total compensation was with the inclusion of the amount that you put in for the 401k plan. And that would then be reflected down here as well in terms of what you put in as contribution. And box 3 and box 5, or at least box 5, which is also an income type of box, would typically be higher possibly than box 1, possibly by the amount that was put into the 401k, because you'd still have to pay Social Security on it. So there's other types of retirement plans that businesses could set up. So if you work somewhere where a simple IRA has been set up, then you can work through the regulations and be able to get some benefit that is similar to a 401k plan, not the same type of benefits, but similar by setting up this simple IRAs. So you can set up the simple IRA and possibly get some tax benefit from that if you're working for a business that has set up a simple IRA. If you are a small business and you have, say, a Schedule C type of business, then there are other type of retirement plan options you may be able to set up, including and they would be similar to in nature but not equal to, simpler usually for small businesses to a 401k type of plan, one of them being a simple IRA. In this presentation, we will take a look at a Simplified Employee Pension SEP SEP. This information can be found in Publication 590A. Simplified Employee Pension SEP. A SEP is a written arrangement that allows your employer to make deductible contributions to a traditional IRA, a SEP IRA, set up for you to receive such contributions. Generally, distributions from SEP IRAs are subject to withdrawal and tax rules that apply to traditional IRAs. You can see Publication 560 for more information about SEPs. So note that a SEP is another type of retirement plan that may be applicable for a small business. So a small business might not want to set up, say, a 401k type of plan because of the complications to set up a 401k, the cost of it, and needing to be in accordance with regulations for it, but may be able to set up some other type of plan and in so doing get similar benefits for themselves and employees. If you are an employer or have a small business and want to look into the Simplified Employee Pension, the SEP, you can take a look at Publication 560. Go to the IRS website, irs.gov, type in pub or Publication 560. Employer and Employee Association Trust Accounts. Your employer or labor union or other employee association can set up a trust to provide individual retirement accounts for employees or members. The requirements for the individual retirement accounts apply to these traditional IRAs. Required disclosures. The trustee or issuer, sometimes called the sponsor of the traditional IRA, generally must give you a disclosure statement at least 7 days before you open your IRA. However, sponsor doesn't have to give you the statement until the date you open or purchase, if earlier, your IRA, provided you are given at least 7 days from the date to revoke the IRA. The disclosure statement must explain certain items in plain language. For example, the statement should explain when and how you can revoke the IRA and include the name, address, and telephone number of the person to receive the notice of cancellation. This explanation must appear at the beginning of the disclosure statement. If you revoke your IRA within the revocation period, the sponsor must return to you the entire amount you paid. The sponsor must report on the appropriate IRS forms both your contribution to the IRA, unless it was made by a trustee to trustee transfer, and the amount returned to you. These requirements apply to all sponsors. In this presentation, we will discuss the question of how much can be contributed. This information can be found in Publication 590A. There are limits and other rules that affect the amount that can be contributed to a traditional IRA. These limits and rules are explained below. Community property laws, except as discussed later under K. Bailey Hutchison spousal IRA limit, each spouse figures his or her limit separately using his or her own compensation. So we're going to look at these limits. We're going to look at what these limits are. Some of them will have to do with compensation and other types of retirement plans that might be involved. And typically we will be figuring these items separately, even with married individuals, when considering community property states. Back to the text, or community property. Typically when we consider community property, we're often considering different states which might have different rules with regard to the type of property within marriage. Back to the text. This is the rule even in states with community property laws. Brokers' commissions. Brokers' commissions paid in connection with your traditional IRA are subject to the contribution limit. For information about whether you can deduct broker commission, see broker commissions later under how much you can deduct. Then we have trustee fees. Trustee administration fees aren't subject to contribution limit. For information about whether you can deduct trustee fees, we'll see trustee fees later under how much can you deduct. In this presentation, we will discuss general limit with relation to traditional IRAs. For 2018, the most that can be contributed to your traditional IRA generally is the smaller of the following amounts: $5,500 or $6,500 if you are age 50 or older. So when thinking about the maximum contribution, the maximum would typically be reported on the Schedule 1, and it would be that $5,500. That's the amount that we can typically deduct as an adjustment to income, the amount that will then be lowering our taxable income and affecting the taxes in the current year or the year of distribution. It could be raised to $6,500 if you are age 50 or older. Your taxable compensation defined earlier for the year. Note that, of course, there is going to be a limit with relation to the taxable compensation. We talked about the items that would be included in taxable compensation in prior presentations. Back to the text. Note, this limit is reduced by any contributions to a Section 501c18 plan, generally a pension plan created before June 25th, 1959, that is funded entirely by employee contributions. This is the most that can be contributed regardless of whether the contributions are to one or more traditional IRAs or whether all or part of the contributions are non-deductible. See non-deductible contributions later. Qualified reservist payments don't affect this limit. And note once again that we're talking about $5,500, and if we had a married couple, then typically both of the individuals would have to think about the qualifications for that $5,500 separately, typically. In other words, if we were talking about a married couple and both were to contribute the maximum, then we have the $11,000, $5,500, and $5,500, which would give the $11,000 here. Here's our little worksheet for that calculation. We'll get more into the calculation later, but in essence, just recall or note that the married couple then would calculate their limits and see if they can then qualify for the maximum, even though we're filing on a joint return. Back to the text. Examples. George, who is 34 years old and single, earns $24,000 in 2018. His IRA contributions for 2018 are limited to $5,500. Danny, an unmarried college student working part-time, earns $3,500 in 2018. His IRA contributions to 2018 are limited to $3,500, the amount of his compensation. If we see that in a 1040, note that we have our 1040 single individual. We're saying that the earnings were only $3,500. That's the only earnings that we're reporting in this scenario. And therefore, we can only deduct then on the IRA $3,500. We can't deduct the full amount of $5,500 for it. So there's the $3,500. If we go back to the 1040, here it is here. Now you might ask, well, why would we do this? Notice if your income was only $3,500, you may not want to put money into an IRA simply to have a benefit on the tax return, because you may not be reporting any income anyways. Because if we had the $3,500 without that deduction, the standard deduction would wipe it out to zero. We wouldn't owe any taxes. And therefore the deduction or a contribution into the IRA may not give us the benefit right now, although the income that's generated on the IRA may still grow and be not taxable until it is distributed at the end. So note, there still is some incentive to put money into a retirement account, even if you don't get that tax incentive. But of course, the tax incentive on the front end is usually something that incentivizes people. And if we don't have a lot of income, or if we're below the limit, then we might not be getting a lot of benefit from putting that into the tax return. And also note, you can kind of tell what that's going to be by seeing what your marginal or effective or your average tax rate is and your highest tax rate, to see how much benefit you're going to get when you put the money into the tax system. However, note that as a student, or if I had low compensation, they still might have significant other income in some kind of situations. For example, if they had a lot of investment income for whatever reason, they might have significant income with relation to other things that don't qualify for compensation with the IRA, like stocks or interest and dividends. And therefore, it could be the case that we're limited through compensation and yet still having an effect on the tax return. Now, if we go back up to our 40,000 of wages, then of course we'll see that this jumps back up to the 5,500. That's going to be the maximum that is deductible. And again, just to think about the amount of benefit we're getting from that, you can consider the highest tax rate, your last dollars, and then the average tax rate to kind of get an idea. So you're putting money in of 5,500 and about maybe like 11.5% we have here. So that would be about 632 of actual tax benefit that is happening. So it's not like you have to pay the 5,500, but you have to put it somewhere where you don't get to touch it for a long time, typically, unless there's some unusual circumstance that you're going to take it out. But in essence, the idea is you put money away for a long time. You got to put 5,500 of it and get something similar or something close to your tax rate in some way. It's a progressive tax system, so it's not the easiest calculation, but some format of that deductible tax rate is what the actual benefit will be upon putting it in, and the growth of it, hopefully it grows, will possibly be deferred as well until it is taken out. Back to the text. More than one IRA. If you have more than one IRA, the limit applies to total contributions made on your behalf to all your traditional IRAs for the year. So you might say, well, what if I have two IRAs? Well, the 5,500 limit is for all basically of the IRAs. So even if you open two IRAs, it doesn't mean you can, up the limit. So you have to keep it at that limit annually. Annuity or endowment contracts. If you invest in an annuity or endowment contract under an individual retirement annuity, no more than 5,500, 6,500 if you are age 50 or older can be contributed toward its cost for the tax year, including the cost of life insurance coverage. If more than this amount is contributed, the annuity or endowment contract is disqualified. In this presentation, we will discuss K. Bailey Hutchison Spousal IRA Limit. This information can be found in Publication 590A. For 2018, if you file a joint return and your taxable compensation is less than that of your spouse, the most that can be contributed for the year to your IRA is the smaller of the following two amounts. 1. 5,500 or 6,500 if you are age 50 or older. 2. The total compensation includable in the gross income of both you and your spouse for the year reduced by the following two amounts. A. Your spouse's IRA contribution for the year to a traditional IRA. B. Any contribution for the year to a Roth IRA. B. Any contributions for the year to a Roth IRA on behalf of your spouse. This means that the total combined contributions that can be made for the year to your IRA and your spouse's IRA can be as much as $11,000, $12,000 if only one of you is age 50 or older, and $13,000 if both of you are age 50 or older. Note, this traditional IRA limit is reduced by any contributions to a Section 501c18 plan, generally a pension plan created before June 25, 1959, that is funded entirely by employee contributions. Example: Kristen, a full-time student with no taxable compensation, marries Carl during the year. Neither of them was age 50 by the end of 2018. For the year, Carl was taxable compensation of $30,000. He plans to contribute and deduct $5,500 to a traditional IRA. If he and Kristen file a joint return, each can contribute $5,500 to a traditional IRA. So if we consider this normally, you would have $5,500 thinking about a traditional type IRA. We have the two individuals. If they both qualify for the maximum, which it looks like they do, then you can typically put in $5,500 for each of the two spouses. Back to the text. This is because Kristen, who has no compensation, can add Carl's compensation reduced by the amount of his IRA contribution. So she's a full-time student, remember, didn't have any income then. But Carl's compensation is $30,000 minus the $5,500 gives the $24,500, and therefore qualifying for the $5,500 for the spouse to put into the IRA. Back to the text. To her own compensation, 0 to figure her maximum contribution to a traditional IRA. In her case, the $5,500 is her contribution limit. Because $5,500 is less than $24,500, her compensation for purposes of figuring her contribution limit. In this presentation, we will discuss filing status with regard to traditional IRAs. This information can be found in Publication 590A. Generally, except as discussed earlier in Hutchison's Spousal IRA limit, your filing status has no effect on the amount of allowable contributions to your traditional IRA. So note that when you think about filing status, except for the exception we saw in the Hutchison Spousal IRA limit, we typically think of the two individuals, even if married, as having their own kind of calculation as to how much they can put into the IRA. So if we have a married couple, then we typically calculate or think about their limits to the contribution separately, the maximum limit typically being that $5,500 unless we're over the age of 50, and then that amount would be calculated here and put on the adjustments to income. Now, if we had two individuals and we were married, then you would still consider the two separately, and you can have a maximum of $11,000 if the two qualify for the maximum contribution and do indeed contribute $5,500 each. However, if during the year either you or your spouse was covered by a retirement plan at work, your deduction may be reduced or limited depending on your filing status and income. So that's going to be the other kind of thing that we need to look at. We have one item, which is going to be how much income we have and what the filing status is. The other thing we're going to have to consider is what's the interplay, what's the relationship to other type of retirement accounts that are set up to do similar types of things, such as very common to have some type of retirement account through work, such as a 401k plan or other type of retirement account. What type of limits are there if we already have some type of retirement account which does a similar activity of reducing the taxable income and saving for retirement as does an IRA contribution? We'll talk about that later. We'll see how much you can deduct later for that example. Examples: Tim and Darcy are married and both are 53. They both work and each has a traditional IRA. Tom earned $3,800 and Darcy earned $48,000 in 2018. Because of the Hutchison Spousal IRA limit rule, even though Tom earned less than $6,500, they can contribute up to $6,500. So note a couple key points here. They're over 50, and therefore the limit is higher than the $5,500. It's up to the $6,500. Note that Tom is under the $3,800, and so you would think under normal type of calculations, you'd say that his contribution, as we think of the two spouses separately contributing, would be limited to $3,800, his income. But that falls into our special limitation or our special rule, non-limitation, it's a good rule, the Hutchison Spousal Limit Rule, which basically allows the spouse to, in essence, contribute some to the limit cap, and therefore allowing the limit to go up to the maximum in this case of someone over 50 being the $6,500. The other spouse, of course, doesn't have any problem over the $6,500 of income and therefore can contribute the maximum, which, because age is over 50, is $6,500 rather than $5,500. Therefore, in both individuals, then both married spouses can contribute the maximum of the $6,500. They can contribute up to $6,500 to Darcy's IRA. If they file separate returns, the amount that can be contributed to Tom's IRA is limited. So note that in this circumstance where they filed married filing joint, they can both record the $6,500 in the IRA. If you decide to file married filing separate, it's usually something that you want to look into and think about, because a lot of things will be limited because the IRS is skeptical about people taking advantage of a marital status and then splitting it. So normally when you're married, you don't have the option of going back to single or head of household. Typically, you have either married filing joint or married filing separate. The IRS considers married filing joint to be the default standard typically, and if you decide to file married filing separate, a lot of things will be eliminated, because I don't think that the code isn't really designed to compensate for that with a lot of the type of benefits that are there. And so what they do is they basically just remove it for a lot of benefits. So this is one of those cases where that special rule wouldn't be there if we decided to file married filing separate. In this presentation, we will discuss situations where we have less and more than maximum contributions to a traditional IRA. This information can be found in Publication 590A. Less than maximum contributions. If contributions to your traditional IRA for a year were less than the limit, you can't contribute more after the due date of your return for that year to make up the difference. For example, if our maximum contribution was $5,500 and we only put $3,000 into the IRA and we planned on putting the rest in to get up to the maximum after the due date of the return, we cannot generally do that. We have to put the money in before the due date of the return. As we consider that, note that when we think about the due dates, and we'll talk more about the due dates later, but we do have time with regard to the due dates past the end of the year, which is nice. So when do we have to put the $5,500 in, or the maximum in, or whatever it is that we're going to deduct? Typically by the due date of the return, meaning if we're talking about 2018, the due date would be April 15th of 2019. That gives you some tax planning. If you're up to the end of the year and we don't have the money into the IRA yet, typically we can do some tax planning at the end of the year and then decide how much to put into the IRA for that tax planning by the due date of the return, by the time we file the return, or by the due date of the return, which would typically be April 15th. The problem, of course, is that we need money in order to put the money into the IRA to get the deduction. So when we think about that tax planning, it's always going to come up and say, hey, we can save possibly this much money if you put this much money into an IRA, possibly $5,500. And then the question is, do you have that much money to put into the IRA? And what you can't do is say, well, I don't have that much money, but I'll put some in later after the due date of the return. That doesn't work. You got to basically do the planning beforehand, have the money ready to put into the IRA, put it in before the due date in order to get the maximum deduction. Example, Raphael, who is 40, earns $30,000 in 2018. Although he can contribute up to $5,500 for 2018, he contributes only $3,000. After April 15th, 2019, Raphael can't make up the difference between his actual contributions for 2018, $3,000, and his 2018 limit, $5,500. He can't contribute $2,500 more than the limit for any later year. So you might think, well, what if I didn't get the limit last year and I can't, amend the return and take the limit, or basically file as the full limit before the return is due and just owe the IRA money? I can't do that. Well, then maybe I can in 2019 have the limit increase because I didn't maximize the prior year. Can't do that. It's a one-time thing. So you got the limit. It's due by the date of the return. If you do less than that amount, then you can't basically say, hey, I'm going to pay I owe the IRA money. Can't really do that. You got to put it in beforehand. You can't do the next return. You can't go to the next return and say, oh, well, the next return, the limit should be increased because I didn't max out the prior return. Can't do that either. More than maximum contributions. If contributions to your IRA for a year were more than the limit, you can apply the excess contribution in one year to a later year if the contributions for that later year are less than the maximum allowed for that year. However, a penalty or additional tax may apply. See excess contributions later under what acts result in penalties or additional taxes. When can contributions be made? This information can be found in Publication 590A. As soon as you open your traditional IRA, contributions can be made to it through your chosen sponsor, trustee, or other administrator. So once we open the IRA, we can open the IRA. Typically, the usual places would be a bank or some type of financial institution. Again, what we're thinking about is opening some type of investment accounts. We're thinking about an item that's going to be, in essence, saving for retirement. How would you save for retirement? Generally, put it in possibly to the bank account, possibly a savings account, possibly stocks and bonds. Those would be the normal ways that we would do so. We would open up then the account. It has to then be in accordance with the IRA, basically under what we would call kind of like an umbrella of the IRA so that it's subject to the regulations of the IRA, typically meaning it's going to be restricted in some way from us taking the money out in order to allow for that deduction. Back to the text. Contributions must be in the form of money, so we have to put actually money into the IRA. That's going to be cash, check, or money order. Property cannot be contributed. So we don't consider property typically as a contribution to something like a retirement account. We have to actually have cash, money going into the retirement account. Although property can't be contributed, your IRA may invest in certain property. For example, your IRA may purchase shares of stock. So we might purchase stock for it. So we invest the money, which is then invested in something else, ownership in basically stock, which would be a form of ownership in typically a corporation. Back to the text. For other restrictions on the use of funds in your IRA, see Prohibited Transactions later in this chapter. Now, obviously, you can think about situations where people get very creative with what can be put into an IRA. So we could think about, well, what other type of creative investments might we be able to put under the umbrella of an IRA in some way, shape, or form? Typically, for most people, they put money into the IRA in very standard type of ways, savings account, stocks, bonds, normal types of investments. But we can consider situations where people might want to be more creative in terms of what they're going to put under the umbrella of an IRA, other types of investments. We'll consider a few of them later. You may be able to transfer or roll over certain property from one retirement account to another. See discussion of rollovers and other transfers later in this chapter under Can You Move Retirement Plan Assets? Tip: you can make a contribution to your IRA by having your income tax refund or a portion of your refund, if any, paid directly to your traditional IRA, Roth IRA, or SEP IRA. For details, see instructions for your income tax return or Form 8888, Allocation of Refund. Contributions can be made to your traditional IRA for each year that you receive compensation and haven't reached age 70 and a half. So we can put contributions into the IRA each year. So each year we consider, do we want to put more money into the IRA? And we consider the IRA, you can think of the IRA as an investment account, some type of investment, typically a savings account, stocks, bonds, the money sitting there that we've been putting in year after year. Hopefully it's growing. Hopefully it's in some type of investment that's doing well and increasing. Our objective then, our task is, do we want to put more money in each year? As we put in more money each year, we can potentially get a deduction on our tax return each year as we put more money in, increasing the value of the amount that's being invested, and hopefully increasing the rate at which it grows and we're not paying taxes on. Now that can happen up until 70 and a half. So at 70 and a half, then typically we're considering the time period where the IRS is saying, hey, now you need to start taking money out possibly of the IRA at this point in time, because they're concerned with other tax consequences at this point in time. Notice that the money and the tax has been deferred up until retirement time. So what they want to have happen then is the money to be drawn out at that retirement time so that someone pays taxes on it at some point. If they let people just give that money to inheritance or something like that and continue deferring the taxes, then you can imagine the IRS is going, hey, wait a sec, no one's paying any taxes. We're supposed to defer the tax, not give free money with no taxes. So they want at some point to have required distributions, because that's the point in time the taxes should be paid. That's the deal. We get a break now. We have to pay it at some point in the future. And therefore, if you're not going to take the money out, we're going to force you to take the money out and pay us some of it at some point. Back to the text. For any year in which you don't work, contributions can't be made to your IRA unless you receive alimony, non-taxable combat pay, military deferral pay, or file a joint return with a spouse who has compensation. So note that we typically need that item of compensation in order to put money into an IRA. It's possible for us to have taxes and not have compensation, meaning it's possible for us to have income such as dividend income, interest income, and be paying federal income taxes and still not qualify for putting money into an IRA if we don't have the compensation to do so. And of course, we saw some exceptions to that. If our spouse is working, we might have an exception to that rule, but that's going to be the typical kind of rule. Contributions must be made by due date. Contributions can be made to your traditional IRA for a year at any time during the year or by the due date for filing your return for that year, not including extensions. For most people, this means that contributions for 2018 tax year must be made by April 15th, 2019, April 17th, 2019 if you live in Maine or Massachusetts. So what that means is we have a little bit of time to put that money into the IRA contribution. In other words, we have the time up until we file the return or the due date of the return, not including extensions. So we have some tax planning. Normally, if we're on a cash basis, you would think the contribution would have to be made sometime within 2018. In this case, we can do some tax planning and actually look at the return, see what it would be, what the contribution would do, how much more gain we would have, or reduction in taxes would be a result if we made the contribution. However, the contribution does need to be made at the due date of the return. We don't get the extension, so we can't extend it and say, hey, the due date's not due until the extended time period. That doesn't work. That doesn't allow us an extension for the money, but we can't put it into the system, into the IRA before the due date of the return. We, of course, need the money in order to do that. We have to actually have the cash in order to put into the IRA to be able to take the deduction, but we can do some tax planning to do so by that time. Age 70 and a half rule. Contributions can't be made to your traditional IRA for the year in which you reach 70 and a half or any later year. So when we reach 70 and a half, remember that the IRS is saying that's the time that you need to take the money out, because the deal is you put money into the IRA, don't have to pay taxes on it. You don't have to pay taxes on the gains until you take it out. And what the IRS doesn't want to see happen is that we say, we're good in retirement. I don't need to take the money out. I'm just going to leave it in there and we'll never pay taxes on it. Well, the IRS doesn't want to see that, so they're going to say, at some point in time, not only are you going to stop putting money into it, but you have to take the money out, and then we get to take some of it at that point in time. So we don't get any money of it when you put it in there. We're going to let you keep it, but we're waiting for you to take it out, and we're going to force you to take it out if you don't do it on an option, and then take it at that point. So when they take it out at 70 and a half, you've got the distributions that typically need to start making around that time. And when that happens, then you'll have to pay taxes as well. You attain age 70 and a half on the date that is 6 calendar months after the 70th annual anniversary of your birth. If you were born on or before June 30th, 1948, you can't contribute for 2019 or any later year. Designating year for which contribution is made. If an amount is contributed to your traditional IRA between January 1st and April 15th, you should tell the sponsor which year, the current year or the previous year, the contribution is for. So just note that it causes a little bit of confusion, the fact that we have until the due date of the return. That means we have the following year, in our case 2019, to make a contribution for 2018. A little confusing if we're making a contribution in 2019 as to which year it should go to, because we could make a contribution in 2019 and apply it either to 2018 or 2019. So just make sure that if you're making a contribution in 2019 and you want to apply it to 2018, make sure that you designate that application so that it is in the records that has been applied to the prior year, and then you can make another contribution as long as you apply it to 2019 in 2019 or by the due date of the 2019 return, which will be April 15th, 2020, and possibly some other days if there's some kind of funny landing point in terms of that due date. Back to the text. If you don't tell the sponsor which year it is for, the sponsor can assume and report to the IRS that the contribution is for the current year, the year the sponsor received it. That's typically going to be the default because typically we're thinking of a cash basis. So if you give the money in 2019 and don't say which year you want to apply it to, then the default is probably going to be, well, I assumed it was for 2019 because that's when I got it. But if you want it to go to 2018 and you give it to someone in 2019, make sure that that is explained and clear. Filing before a contribution is made. You can file your return claiming a traditional IRA contribution before the contribution is actually made. Now, to be safe, you probably don't want to do that in best practices. You'd probably like to say, hey, I put money into an IRA, now I'm going to file the return. But you can't put the money in before as long as you put the money into the IRA by the due date of the return. Back to the text. Generally, the contribution must be made by the due date of your return, not including the extensions. We can imagine a situation like this happening. If we're doing tax preparation and we're getting advice and the advice says, hey, you can save $600 or so if you put this much money into an IRA plan, and then you say, okay, I'd like to do that, then could you file the return and I'll go do that right now? It could possibly be the case that that could happen, but make sure that you do go ahead and put the money into an IRA. And again, you'd probably be better off putting the money in before filing the return, just to make sure that you do it before the return's due date. Back to the text. Contributions not required. You don't have to contribute to your traditional IRA for every tax year, even if you can. So no, you might start thinking, well, what if I start an IRA and I don't want to put money into it next year? That's okay, because the IRA is still there. It's just you can think of it as some type of savings account, typically a savings account, a CD, or some type of savings account at the bank, or some investment like stocks and bonds. It'll still be there. So the contribution you made last year will still be there. It'll hopefully be growing. We won't be paying taxes on it because we don't have to pay taxes on it until it's distributed. If you want to put more money into it, then you can make that decision each year. However, you're not required to do so. In this presentation, we will discuss how much you can deduct with relation to a traditional IRA. This information can be found in publication 590A. Generally, you can deduct the lesser of the contributions to your traditional IRA for the year, or the general limit, or the K. Bailey Hutchison spousal IRA limit, if applicable, explained earlier. So we discussed that item earlier. So typically, obviously, you can usually deduct what you contribute into the IRA up to the maximum, up to the limit. So if the limit is $5,500 for us, then if we contribute something less than that, we would typically get the deduction of something less than that. If we happen to put something more than that in, then of course we can't take the deduction higher than our maximum limit. If it was, in this case, $5,500, then the $5,500. There are some special rules as to what this limit will be, or what the restrictions are if we're married and we have the income limitations, or how much restriction there are for the income with relation to the special rule for K. Bailey Hutchison spousal IRA limits. Remember that as we think about the deduction, we're not thinking about the tax savings. We're thinking about how much the income, the taxable income, will go down by. So this is a deduction which will be reducing the taxable income as we move from line 6 to line 7, the adjusted gross income then being affected. And we can think about, well, what's going to be the effect on the taxes? To think about that, we've got to figure out, well, what tax rate are we in, and give some type of average estimate for it. If we're in about, in this case, 11.5 tax rate or something like that, and we contribute $5,500, reducing our income by $5,500 times the 0.115, 11.5, let's say, we got the 638. So the tax savings aren't going to be the amount that we deduct. It's a deduction. The tax savings depend on other factors, including, of course, our tax rate. Back to the text. However, if you and your spouse was covered by an employer retirement plan, you may not be able to deduct this amount. See limit if covered by employer plan, and we'll discuss that later. The other type of restriction, of course, that we might have, other than the income limitations we've discussed in prior presentations, and the cap that we would have on how much we can put into the IRA, would be whether or not we have another similar type of account. Do we have some other kind of retirement account, such as, say, a 401k plan from the employer, which does much the same thing, although it would be taken out of the W-2 already reported for us as we enter the W-2, then box 1 already reflecting the reduction in income, therefore having no need for the added schedule to make the deduction here. But in essence, it's the same thing in that it reduces the taxable income, and therefore the question is, well, if there's a limit, if there's a cap, if there's so much I can put into an IRA, do I have a limit with regard to what if I have another type of plan, which in essence does the same thing? And of course, yes, there are limitations, and we'll take a look at those limitations in a future presentation. Tip: you may be able to claim a credit for contributions to your traditional IRA. For more information, you can see Chapter 3. Trustees' fees. Trustees' administrative fees that are billable separately and paid in connection with your traditional IRA aren't deductible as IRA contributions. You are also not able to deduct these fees as itemized deductions. Broker's commissions. These commissions are part of the IRA contributions and, as such, are deductible subject to the limit. Fuel deduction. If neither you nor your spouse was covered by any part of the year by an employer retirement plan, you can take a deduction for total contributions to one or more of your traditional IRAs up to the lesser of $5,500, $6,500 if you are age 50 or older, or 100% of your compensation. This limit is reduced by any contributions made to a 501c18 plan on your behalf. K. Bailey Hutchison Spousal IRA. In the case of a married couple with unequal compensation, so we talked about this in a prior presentation. We have a married couple, uneven compensation for whatever reason. Then we have some special situations which might help out in the contributions to an IRA. Back to the text. Who file a return, the deduction for contributions to a traditional IRA of the spouse with less compensation is limited to the lesser of $5,500, $6,500 if the spouse with the lower compensation is age 50 or older, or the total compensation includable in gross income of both spouses for the year reduced by the following three amounts. A. The IRA deduction for the year of the spouse with the greater compensation. B. The designated non-deductible contribution for the year made on behalf of the spouse with the greater compensation. C. Any contributions for the year to a Roth IRA on behalf of the spouse with the greater compensation. This limit is reduced by any contribution to a Section 501c18 plan on behalf of the spouse with the lesser compensation. Note, if you were divorced or legally separated and don't remarry before the end of the year, you can't deduct any contributions to your spouse's IRA. After divorce or legal separation, you can deduct only the contributions to your own IRA. Your deductions are subject to the rules for single individuals. Covered by employer retirement plan. If you or your spouse was covered by an employer retirement plan at any time during the year for which contributions were made, your deduction may be further limited. So if we had an employer plan, such as possibly a 401k type plan, we're going to have to discuss those limitations at a later time. Back to the text. This discussion later under limit if covered by employer plan. Limits on the amount you can deduct don't affect the amount that can be contributed. In this presentation, we will discuss the question of, are you covered by an employer plan? The Form W-2 you receive from your employer has a box used to indicate whether you were covered for the year. The retirement plan box should be checked if you were covered. So we have a retirement plan box on the W-2, which will give us that indication of whether or not we were covered by a retirement plan. Why is that important? Because it can affect how much we can contribute or if we can contribute into an IRA. Here's an example of a W-2 form. If we take a look at box 13, we have the retirement plan here. Typically, if we have a retirement plan, then we'll have the checkbox will be indicated. And then the question is, well, how much did we put into the retirement plan? And it'll often be over here in box 12, one of the items in box 12. And many times it's going to, every time, if deductible or if it's a reduction to income, reduce the wages in box 1. Box 1, of course, is what we're going to report on the 1040. So the 1040 will be reported here. If we're talking about wages that's not taxable, in other words, we kind of got in the same thing as a deduction. It's just not going to be included in wages in this case because it's not going to be included on the tax return at all. So similar to what we have here for the IRA, except that it's just never going to be included in income because it's already been dealt with the W-2 form. So it's not going to be included in box 1. We can see it though. It should be down here indicated with a line item in box 12. And if we subtract the difference between box 1 and box 5, which is Medicare wages, which you don't get to get the deduction for the calculation of Medicare wages. So box 5 should be higher in terms of compensation than box 1. And the difference may be, if it's not too complex of a return, there could be other things involved. But if it's not too complex of a W-2 form, the difference may be the amount of contribution to the IRA or to the 401k plan or whatever type of retirement plan is set up. Most common for larger companies being a 401k type of plan. Back to the text. Reservists and volunteer firefighters should also see situations in which you aren't covered later. If you aren't certain whether you were covered by your employer's retirement plan, you should ask your employer. It's going to be a big benefit to have a retirement plan or a 401k plan at the employer. So if you can take advantage of it, it would be great. You can have two things have to happen. It is an optional plan typically to set up by the employer, something like a 401k type of plan. So you would have to have an employer that would want to set it up. And if they have it set up, then it's typically voluntary. It's not something you have to sign up for. So typically you would have to volunteer for the plan, which is something they may advertise well because it is a big benefit. And then you would elect to go through the contributions in the plan. The other thing you, of course, need is that if you're living paycheck to paycheck, you may not have the money to benefit from it because you can't put the money into the 401k plan anyways because you don't have the money to put into the plan. But so you need to have some amount of compensation that you're able to take out of the paycheck to take advantage of the 401k plan. So it has to be offered. It has to then, you have to be able to qualify. And one of the qualifications being that you have some money that you can take out of your W-2, your check each month or each week or whatever pay period you're in and put it into the 401k plan. Back to the text. For which years are you covered? Special rules apply to determine the tax years for which you are covered by an employer plan. These rules differ depending on whether the plan is a defined contribution plan or a defined benefit plan. So it gets a little bit confusing as to the question of, all right, I'm covered. So now which year does it apply to? And there's different types of retirement plans. We can have a contribution plan or a defined benefit type of plan. Back to the text. Tax year. Your tax year is the annual accounting period you use to keep records and report income and expenses on your income tax return. For almost all people, the tax year is the calendar year. Defined contribution plan. Generally, you are covered by a defined contribution plan for a tax year if amounts are contributed or allocated to your account for the plan year that ends with or within that tax year. However, also see situations in which you aren't covered later. A defined contribution plan is a plan that provides for a separate account for each person covered by the plan. In a defined contribution plan, the amount to be contributed to each participant's account is spelled out in the plan. The level of benefits actually provided to a participant depends on the total amount contributed to that participant's account and any earnings and losses on those contributions. Types of defined contribution plans include profit sharing plans, stock bonus plans, money purchase pension plans. So a defined benefit plan or defined contribution plan, in essence, you can think of the key term as the contribution, means that we're actually making a contribution. That contribution we can apply to the individuals involved here. So we can actually apply the contributions out to the individuals as opposed to putting the money into some kind of pool and then giving that money out of the pool in accordance with some kind of rules and regulations for the pool at the retirement time. Example, Company A has a money purchase pension plan. Its plan year is from January 1st to June 30th. The plan provides that contributions must be allocated as of June 30th. Bob, an employee, leaves Company A on December 31st, 2017. The contribution for the year for the plan year on June 30th, 2018 is made on February 15th of 2019. Because an amount is contributed to Bob's account for the plan year, Bob is covered by the plan for his 2018 tax year. A special rule applies to certain plans in which it isn't possible to determine if an amount will be contributed to your account for a given plan year. If for a plan year, no amounts have been allocated to your account that are attributable to employer contributions, employee contributions, or forfeitures by the last day of the plan year and contributions are discretionary for the plan year, you aren't covered for the tax year in which the plan year ends. If after the plan year ends, the employer makes a contribution for that plan year, you are covered for the tax year in which the contribution is made. Let's take a look at an example. Mickey was covered by a profit-sharing plan and left the company on December 31st, 2017. The plan year runs from July 1st to June 30th. Under the terms of the plan, employer contributions don't have to be made, but if they are made, they are contributed to the plan before the due date for filing the company's tax return. Such contributions are allocated as of the last day of the plan year, and allocations are made to the accounts of the individuals who have any service during the plan year. As of June 30th, 2018, no contributions were made that were allocated to the June 30th, 2018 plan year, and no forfeitures had been allocated within the plan year. In addition, as of that date, the company wasn't obligated to make a contribution for such plan year, and it was impossible to determine whether or not a contribution would be made for the plan year. On December 31st, 2018, the company decided to contribute to the plan for the plan year ending June 30th, 2018. That contribution was made on February 15th, 2019, so it was made in 2019. If Mickey is an active participant in the plan for his 2019 tax year, but not for his 2018 tax year. No vesting interest. If an amount is allocated to your account for a plan year, you are covered by that plan even if you have no vested interest in legal right to the account. So even if you're not vested, vested is going to be one of these terms that are going to be specific to certain types of plans, and it means basically you don't have the legal right to it yet, or at this point in time, because you're not vested within the plan. You haven't fulfilled all the regulations in order to qualify for, in essence, a legal right at this point in time. Defined benefit plan. So here's the other type of plan that we have, a defined benefit plan. If you are eligible to participate in your employer's defined benefit plan for the plan year that ends within your tax year, you are covered by the plan. This rule applies even if you declined to participate in the plan, didn't make a required contribution, or didn't perform the minimum service required to accrue a benefit for the year. A defined benefit plan is any plan that isn't a defined contribution plan. So it's defined as what is not a defined contribution plan. Back to the text. In a defined benefit plan, the level of benefits to be provided to each participant is spelled out in the plan. The plan administrator figures the amount needed to provide those benefits, and those amounts are contributed to the plan. Defined benefit plans include pension plans and annuity plans. So you can see how this is kind of working a little bit different. It's basically saying, hey, we're going to work out the amount that we're going to pay at the end of the retirement, and instead of basically making those payments based on what is contributed during the time period, we are then going to try to figure out how much we need to contribute to the pool to be able to compensate in accordance with the agreements that we have made with the plan. So in other words, you can think of it as each employee in a contribution plan knows how much of the amount has been contributed for them. They have their own specific, basically, claim to the money, or the account is specific to them. We can track it to the employee, as opposed to a benefit plan where we don't have that situation. Each employee has rights to the retirement benefits, but those are based on the agreement that has been made about what the retirement should be paying out for it, and how the retirement benefit plan is going to be funded is going to be is a separate situation. The company has to figure out how to fund the retirement plan so that it can comply with, or be in accordance with, or be able to meet the needs of what the agreements are for the benefits that are to be paid out. So that's just a brief overview of the difference between the two, how you can kind of think about those two types of plans. Back to the text. Example: Nick, an employee of Company B, is eligible to participate in Company B's defined benefit plan, which has a July 1st to June 30th plan year. Nick leaves Company B on December 31st, 2017. Because Nick is eligible to participate in the plan for its year ended June 30th, 2018, he is covered by the plan for his 2018 tax year. No vested interest. If you accrue a benefit for a plan year, you are covered by that plan even if you have no vested interest in legal right to the accrual. Situations in which you aren't covered. These are going to be types of situations when you are not covered. If you're not covered, then you don't have that kind of restriction. We don't have to then think about, well, what's going to be the restriction for us to put into something like an individual retirement plan. So remember, we're talking about a company plan, which could interfere with or change the amount, or the amount that we can put into an IRA contribution. Unless you're covered by another employer plan, you aren't covered by an employer plan if you are in one of these situations described below. Social Security or railroad retirement. Coverage under Social Security or railroad retirement isn't coverage under an employer retirement plan. Benefits from previous employer's plan. If you received retirement benefits from a previous employer's plan, you aren't covered by that plan. So if it's a plan that you had in the past from a previous employer. Reservists. If the only reason you participate in a plan is because you are a member of a reserve unit of the armed forces, you may not be covered by the plan. You aren't covered by the plan if both of the following conditions are met. The plan you participate in is established for its employees by the United States, B, a state or political subdivision of a state or an instrumentality of either A or B above. 2. You didn't serve more than 90 days on active duty during the year, not containing duty for training. Volunteer firefighters. If the only reason you participate in a plan is because you are a volunteer firefighter, you may not be covered by the plan. You aren't covered by the plan if both the following conditions are met. 1. The plan you participate in is established for its employees by A, the United States, B, a state or political subdivision of a state, or C, an instrumentality of either A or B. 2. Your accrued retirement benefit at the beginning of the year won't provide more than $1,800 per year at retirement. In this presentation, we will discuss limits if covered by employer plan. This information can be found in Publication 590A. So we've talked about whether or not we are covered by an employer plan in prior presentations. Now we want to know what that means with regard to the IRAs that we're concentrating on here. What's going to happen to the amount that we can contribute into an IRA if we have an employer plan. In other words, note that putting money into a retirement plan is one of the greatest or biggest benefits typically that we can have for most taxpayers or many taxpayers because it's an above-the-line deduction, not subject to the itemized deduction limitations. So if we have the money, it's a great type of deduction to have. The limitation is, of course, how much can we put in? If we have enough money, it would be nice to increase that limit, put more in. We could do so if we have a 401k plan or some type of plan with an employer, and possibly put more money into an IRA if that is an option as well. So to do that, we'll think about, well, what are going to be kind of the limits if I have an employer plan and I want to put more money in to the IRA. Back to the text. Limit if covered by an employer plan. As discussed earlier, the deduction you can take for contributions made to your traditional IRA depends on whether you or your spouse was covered by any part of the year by an employer retirement plan. Your deduction is also affected by how much income you had and by your filing status. Your deduction may also be affected by Social Security benefits that you receive. Reduce or no deduction. So we have a reduced or no deduction. If either you or your spouse was covered by an employer retirement plan, you may be entitled to only a partial reduced deduction or no deduction at all, depending on your income and filing status. So if we have either our spouse or us has some type of retirement plan, like a 401k plan or something like that with an employer, something that we typically would assume would be on the W-2, usually most times, and be indicated here on line 13 where it says retirement plan, that then complicates the situation as to whether or not we can put into an IRA. And note, this is where it's nice and beneficial that oftentimes it's the end of the year. If we get the filing, the IRA contribution isn't due until the tax return is due. So it's often, if we have the money, it's one of those last kind of things that we could set up and think about before the tax return is due, and possibly consult a tax professional and say, hey, is there any last minute thing we can do, such as put money into the IRA to save a little bit more money, even though we have a retirement plan. Tax software then helping us out with these rules and regulations to make that final determination. So that might be something you want to think about as you start to prepare the returns. Note that if you go to extension, it's too late. So if you're thinking about tax planning for 2018 in the extended time period past 2019, April 15th, then you'll have a problem. But if you do some planning before that time, then you may be able to get some help as you start to prepare the taxes with regard to these limitations, which can be a bit more complex. Back to the text. Your deduction begins to decrease, phase out, when your income rises above a certain amount and is eliminated altogether when it reaches a higher amount. These amounts vary depending on your filing status. To determine if your deduction is subject to the phase out, you must determine your modified AGI. So you might think, well, what is that? Modified AGI? So this is the phase out. So we're thinking about our income. And the tax code says once your income gets high enough, we're going to start to take away the things that are going to benefit you, and we're going to, take more of your money, or at least not allow you to do some of the things that might help you to save money past that certain point. In any case, as income goes up, there you got these phase outs that end up happening. Oftentimes they're going to be based on the line 7 adjusted gross income. So line 7 is adjusted gross income. You'll note that adjusted gross income is adjusted by one of the adjustments being, in other words, the IRA deduction. So that's going to complicate the things a little bit. If we're going to say, hey, as your adjusted gross income goes up, this amount of deduction is going to go down possibly, or could be limited, but this deduction is there in calculation of the AGI, which is the limit that's going to limit this thing on how much we can deduct. So it's kind of a loop type of situation. So we might need some modifications. But in any case, note that anytime the tax code, or most of the time when the tax code says modified adjusted gross income, that means we're going to start with adjusted gross income line 7, do some type of modification that is specific to that particular thing that we're doing, in this case specific to the calculation here. So we're basically starting with the line 7, adjusted gross income, and then the modifications are usually somewhat minor in comparison with that. And the general rule you want to keep in mind is it's basically an income limitation. As your income goes up, you could be subject to the phase-out limitations. Back to the text. Once you have determined your modified AGI, your filing status, you can use Table 1.2 or 1.3 to determine if the phase-out applies to you. Social Security receipts, instead of using Table 1.2 or Table 1.3 and Worksheet 1.2, complete the worksheet in Appendix A of this publication if, for the year, all the following apply. You receive Social Security benefits. So this is a case where we're receiving Social Security benefits. Remember that we put money into Social Security at various times, possibly at retirement age or possibly before for some other type of reasons. We might be receiving Social Security benefits. Next items, you receive taxable compensation. Contributions were made to your traditional IRA. You or your spouse were covered by an employer retirement plan. Use the worksheet on Appendix B to figure your IRA deduction, your non-deductible contribution, and the taxable portion, if any, of your Social Security benefits. Appendix B includes an example with fill-in worksheets to assist you. Deduction phase-out. The amount of any reduction in the limit on your IRA deduction, the phase-out, depends on whether you or your spouse was covered by an employer retirement plan. So that's going to be one of the major concerns here. We've talked about the limits before that, which are pretty straightforward. Now we're considering the more complex situation where we have some type of employer plan, which usually would be indicated on the W-2. What's going to be the reduction in the deduction related to the IRA? Back to the text. Covered by a retirement plan. If you were covered by an employer retirement plan and you didn't receive any Social Security retirement benefits, your IRA deduction may be reduced or eliminated depending on your filing status and modified AGI as shown in Table 1.2. If your spouse is covered, so now it's not even you, it's your spouse that's covered, what's going to be the effect or impact there to the contribution? Because remember, we thought before that the contribution would be thought of as, in essence, separately. We typically, general rule, think of the maximum or limitations on the contribution to the IRA separately, even though we have married individuals with certain exceptions to that rule. Back to the text. If you aren't covered by an employer retirement plan, but your spouse is, and you didn't receive any Social Security benefits, your IRA deduction may be reduced or eliminated entirely depending on your filing status and modified adjusted gross income as shown in Table 1.3. So here's Table 1.2. Effect on modified AGI on deduction if you are covered by a retirement plan at work. If you are covered by a retirement plan at work, use this table to determine if your modified AGI affects the amount of your deduction. So here's how the table is going to work. If your filing status is, here's the filing status, then we'll go to and your modified adjusted gross income. We have the adjusted gross income limits. Then this is going to be the effect or the impact. Let's go through it line by line. If your filing status is single or head of household, and your modified AGI, adjusted gross income, which again, line 7, with certain modifications on the tax return on the 1040, more 63,000 or less, then a full deduction. So if you're less than 63,000, single, head of household, no problem, you're good, go forward. If your filing status is single, head of household, and your modified adjusted gross income is more than 63,000, but less than 73,000, well, then you're in the most complex portion, and we have to figure out what the partial deduction is. Be nice to have some tax software to do that at that point in time, if applicable. And if your filing status is single, head of household, and you have more than 73,000 or more, well, then you're over the cap. You're not good in terms of being able to deduct the IRA contribution, and you won't be able to get the added bonus of the IRA. In other words, if your income is over that amount, then you may be benefiting from the 401k plan or whatever retirement plan you have put in, because it will then be reflected in box 1 being reduced. Even though you got compensation, it'll be reflected here. You'll have a check mark there, and you'll have some type of retirement amount down here. But you won't generally then be able to put more money in to an IRA account and be able to benefit there. Now, you might have an IRA account from the past that's still there that you didn't put any more money into. That's fine. But you can't get the deduction from putting more money in to the IRA typically at that point. Next item, if your filing status is married, filing joint, or qualified widow, widower, and your modified AGI is 101,000 or less, then you're okay. Then you can have the full deduction. If you're married, filing jointly, or a qualified widow or widower, and you're between 101 and 121, then you're in that complex zone where you can't get the full deduction. There's some kind of partial deduction limitation we're going to have to figure out. It'd be nice to have tax software at that point to do so. If you're married, filing jointly, qualified widow or widower, and you're over 121 or 121 or more, as it says here, then you're not good, and you won't get that deduction for the increase for the IRA. And then finally, you're married. If your filing status is married, filing separately. And again, remember, the IRS doesn't like when people do that with these type of deductions, so they limit a lot of things. So married, filing separately, and your modified AGI is less than 10,000, then a partial deduction. You have a partial deduction. Married, filing separately, 10,000 or more, no deduction. So again, this is one of those things where the IRS basically says, hey, if you're married, you should file married. This is what basically the implication of the law is, how I interpret it. If you're married, the IRS says you should be filing married, and that's it, really. But you can file married filing separately, but we're going to take away a lot of stuff. So a lot of the things that may be a little bit unusual or outside the norm, including the IRA deduction. If a spouse has a retirement plan, the IRS basically says we're just going to pretty much eliminate the benefit there. So if you're looking for the benefit here, you probably want to file, if at all possible, married filing jointly for that process. Again, if you're married, you can't jump over typically to single or head of household. You typically have two options: married filing separately. Married filing separately oftentimes is not favored by the IRS with regard to many kind of items. Next table, the table 1.3, effect on modified AGI on deduction if you aren't covered by a retirement plan at work. So now we're talking about a situation where you aren't covered by a retirement plan at work. If you aren't covered by a retirement plan at work, use this table to determine if your modified AGI affects the amount of your deduction. If your filing status is single, head of household, or qualified widow, widower, and your modified AGI is any amount, then you can have the full deduction, because you don't have any other benefit. You don't have any other out. And notice the IRS is basically saying, well, I mean, if you don't have any other thing, that's really where you would think that the IRA deduction would play out for sure. Because if you're working somewhere and they don't provide you with a retirement plan, then you would think, well, I should get something. I should be able to put money. I should get some type of benefit like everybody else does. So then they give you, well, we'll let you put $5,500 into an IRA. And so you would think that would be the case. And then married filing joint and separately with a spouse who isn't covered by a plan. Again, in any limit, there's not an AGI limit, and you can typically take the deduction. Married filing jointly with a spouse who is covered by a plan at work. So now it's a little bit more tricky. Now you're saying, well, my spouse is covered and we're married, but I'm not covered. So if we took a look at the W-2s, one of the spouses possibly has a retirement plan and the other does not. But the IRS kind of thinks of you as one person kind of for taxes because you're married and you file like one. So that's a little bit more of a confusing type of situation. So in that case, and your modified gross income is $189,000 or less, so it's pretty high, then you're still good and you could take the deduction, meaning your spouse has a 401k plan, and so they maybe not be able to, according to this table, right, because they have a retirement plan, but you may still be able to. The spouse that doesn't have the retirement plan may still be able to, but if the AGI limit on line 7 of the joint return is greater than or less than 189, then you should be good and take the deduction for the spouse that doesn't have the coverage. And then if you're in between, more than 189 but less than 199, then you have that phase out kind of partial deduction situation. And over 199,000, then you're going to lose the deduction even though you don't personally possibly have a retirement plan, but your spouse does, filing joint. If married filing separate with a spouse who is covered by a plan at work, less than 10,000 is a partial deduction, 10,000 or more, no deduction. Filing status. Your filing status depends primarily on your marital status. That's where their focus is. For this purpose, you need to know if your filing status is single or head of household, married filing jointly, or qualified widow, widower, or married filing separately. If you need more information on filing status, see publication 501, exceptions, standard deduction, and filing information. Form 1040. If you file Form 1040, refigure the amount on page 2, adjusted gross income line, without taking into account any of the following amounts. So this is kind of what we're thinking about of the, as they say here, the modified portion of the AGI. So we're modifying line 7, adjusted gross income, AGI. So we'll have the IRA deduction. Well, obviously we have to take that out because it's part of the AGI. So that's really kind of the most confusing thing here. It's like, well, that's gonna mess up AGI calculation. And then we got the student loan interest deduction, domestic production activities deduction, foreign earned income exclusion, foreign housing exclusion, exclusion of qualified saving bonds, exclusion of employer provided adoption. So note, these are more unusual. This one's not too unusual, but these are pretty unusual, may not apply. This one, of course, is going to be considered because we might have that as what we're looking for. And so that's going to be your modified AGI. Income from IRA distributions. If you receive distributions in 2018 from one or more traditional IRAs and your traditional IRAs include only deductible contributions, your distributions are fully taxable and are included in your modified AGI. See publication 590B for more information on distributions. We're concentrating here on the contributions, getting the deduction on the front end as we put the money in to the IRA, but of course we also to consider more, you want to consider the distributions as well to get the full picture of the money going out of the IRA at the point of retirement. Both contributions for 2018 and distributions in 2018. If all three of the following apply, any IRA distributions are received in 2018 may be partly tax-free and partly taxable. You received distributions in 2018 from one or more traditional IRAs. You made contributions to a traditional IRA for 2018. Some of those contributions may be non-deductible contributions. If this is your situation, you must figure the taxable part of the traditional IRA distributions before you can figure your modified AGI. To do this, you can use Worksheet 1.1 in Publication 590B. In this presentation, we will use tax software to consider contribution limits. Here we are in our test 1040. We have the simple single individual we will test out first. Note we're currently on the 40,000 and we have under 50-year-old here, and therefore the limit or the amount of contribution is typically going to be the 5,500 at the maximum. What we're considering here is the AGI or adjusted gross income limitations, that typically being on line 7. So note if we have no other 401k plan that's applicable that's there is no limit. So we can have an AGI limitation increase to pretty much whatever. So if we earned $1 million on the W-2 and we go to the amount of deduction, we could still deduct the limit or the cap or the maximum of 5,500. And that in essence makes sense because even though the AGI is very high here, if we consider the situation where we work somewhere, we get W-2 employee and we get W-2 wages and they don't offer a retirement plan, we're not getting that benefit at all. We're not getting the retirement plan. So it would make sense that we would get some type of deduction if we don't have any other retirement plan, because we should get some type of retirement plan in some way, shape, or form. And if it's not offered through work, then there's no limitation on it. Now, if we have a situation where we do have a retirement plan at work, then the limitations differ. How do we know if we have a retirement plan? Typically, it'll be checked here. So we'll have the retirement plan on the W-2. We'll often have the amount we contribute in box 12, but note that just being eligible for the retirement plan oftentimes will be enough to trigger basically the restrictions. So if you're eligible for the retirement plan, then you want to take advantage of the retirement plan and put money, plan for it, put the money into the retirement plan because you may be restricted based on AGI limitations. Then that information can be put into the tax return, usually with an indication of the retirement plan being available. Tax software is not the code. It's not equivalent to the code, so we want to know the law, the code. But the tax software, of course, is based on the code. So we could put stuff into the tax software and see if it lines up to the code. That really helps us to understand things better and pick up problems if our understanding is off. So obviously in practice we do this a lot. If you have access to the software, great. If you don't, then hopefully this will give you some examples of it. But it's useful to run through scenarios to get some actual feeling of what the tax software is doing, what the forms are doing, and get some alignment from the software, what's being programmed to the code. So if we had 50,000, then we're under the limit. We still get the deduction of the 5,500. If we're single or head of household and we're between 63,000 and 73,000, that should phase out. So if we go to if we increase this to 65, let's say $68,000, then we're going to say, all right, now it's been limited, right? And it's going to be limited according to this worksheet. So you can go through the worksheet and see how they're going to basically limit the phase out. But in essence, you note that if it's up to 63,000 for single or head of household, you should still be good even if you have a retirement plan at the work. If you're over the 63,000, you're going to have an issue or a phase out, and it's really nice to be able to have tax software, because in this situation, what you would like to do is say, all right, I know that I have a 401k plan or some type of retirement plan. I'm going to put my information into the tax software, see what it comes up with, and see if I can contribute any more to an IRA or some other type of plan, and then do so at that point in time. So that's what this is going to be. And of course, if it's over the 73,000, let's say 74,000, then gone, it goes away. We don't get any benefit at that point. Now for married filing joint, so now we're married filing joint here, and we're saying that we have 100,000 of income, and it's from the one taxpayer that put the money in, that is looking to see if they could put into the IRA. Then we still have the 5,500, even though once again there's a retirement plan for that individual. So we have this individual retirement plan there, still have the 5,500. If though it goes up above 101, let's say 112,000, then of course it starts to phase out in a similar fashion. And if we go above 121, let's say 122,000, then it goes away. So we see a similar fashion there. If you file married filing separate, it's going to be severely limited. I won't even go into it. So if you want that benefit, you probably don't want to file married filing separate for the most part. And then we could have a situation where our spouse has a retirement plan. So if we have the spouse has a retirement plan, then we could have a limitation if we're over and we don't. So the spouse has a retirement plan and we're looking to put an IRA in on the other account that doesn't have basically a retirement plan on work, still going to be limited. So if, for example, you have the two individuals, one of them has a retirement plan, doesn't earn a lot, but they have the retirement plan, the other doesn't have the retirement plan, and this is the other spouse, then you could see limitations. In this case, we're going to say that we're going to ask for the retirement plan on the spouse here, and see if we get that. We're going to say, all right, there's the retirement plan. But if this one goes over, even though this spouse doesn't have a retirement plan, that's what we're looking for the IRA for, and we say that we want to have the 199,000 or 180,000, then it's going to be limited at the 4,950. So we get the limit, we start to phase out, even though again there's no retirement plan here. And then if we go to the 190,000, we're going to say that we lose it altogether. In this presentation, we will discuss how to figure reduced IRA deduction and reporting deduction contributions. This information can be found in publication 590A. How to figure your reduced IRA deduction. If you or your spouse is covered by an employer retirement plan and you didn't receive any Social Security benefits, you can figure your reduced IRA deduction by using Worksheet 1-2. The instructions for Form 1040 and Form 1040-NR include similar worksheets that you can use instead of the worksheet in this publication. If you or your spouse is covered by an employer retirement plan and you received any Social Security benefits, see Social Security receipts earlier. Note, if you were married and both you and your spouse contribute to IRAs, figure your deduction and your spouse's deduction separately. So note, if we have a situation where we have a reduction, then we're going to have to use worksheets in order to figure out what that reduction will be. For example, if we have our 1040 here and we have a simple single individual and we put in 64,000 and then there's 64,000 of wages and we want to put money into an IRA. We want to max out. Our maximum was 5,500, but we're over the AGI limitation. So there's going to be some type of reduction, as we'll see on the Schedule 1. So the Schedule 1, we're at 4,950, and we'd have to go through the worksheet for the reduction. Now again, it's really useful to have software if you're in that zone where you're going to have a reduction, because the software will help with that tax planning process. So if you're under the limit to where you're going to have a reduced amount, not really an issue, because then it's pretty straightforward, whatever the deduction will be. If you're over, then there's not a problem, because if you're over the amount where you get any deduction, then you're just not going to get any of the deduction. If you're within that range, then you can use the worksheets within the publication and or tax software. Note that, again, this is something you can do at the end of the year. Put in your information and consider what you might be able to put into an IRA, and then do so as long as you file before the due date, not including the extensions typically. Worksheet can be found in the publication. You can also see a worksheet similar in this item using the tax software to get an idea of how that reduction calculation would be. This would be based on a 5,500 contribution that was then limited due to the restrictions. So we have this limitation here, and so you can go through those calculations. We won't go through it all in detail at this time. Back to the text. Reporting deductible contributions. If you file Schedule 1, Form 1040, enter your IRA deduction on line 32 of that form. So there it is, Schedule 1, 1040. We are on line 32 of that form. And note that this is going to be a new schedule, the Schedule 1 for 2018, as there's been adjustments to the form, but in essence, it's the same kind of area adjustments to income now on Schedule 1 rather than the 1040 now being a simplified or shorter type of form. Back to the text. If you file Form 1040-NR, enter your IRA deduction on line 32 of that form. You can't deduct IRA contributions on Form 1040 NREZ. Self-employed. If you are self-employed, a sole proprietor or partner, and have a simple IRA, enter your deduction for allowable planned contributions on Schedule 1, Form 1040, line 28. If you file Form 1040 NR, enter your deduction on line 28. So here's the Schedule 1, here's the self-employed SEP or simple, line 28 for that item. In this presentation, we will discuss non-deductible contributions. Non-deductible contributions. Although your deduction for IRA contributions may be reduced or eliminated, contributions may be made to your IRA up to the general limit, or if it applies, the K. Bailey Hutchison spousal IRA limit, the difference between your total permitted contributions and your IRA deduction, if any, is your non-deductible contribution. In other words, when we consider putting money into the IRA, note there's two things we're typically considering. If we're putting money into the IRA, we typically want that deduction. That's the first thing that's going to come to mind. We're going to say, hey, I would like to get a deduction, and we'll say this is going to be the amount that we get to deduct, and that will affect the amount of tax we pay. It won't be a line-for-line deduction. I mean, it won't be a dollar-for-dollar deduction like a credit. It will be a deduction acting like a deduction. You can see, though, the deduction may be limited. So we may limit the deduction. We've discussed some of the limitations on the deduction. Because we have a limited deduction, however, doesn't necessarily mean that we can't put a contribution into the IRA. So then the question would be, well, why would I want to? Why would I want to put a contribution into an IRA if I don't get the deduction? What's the point? But note that, again, if you put the money into the IRA, it's possible that the earnings on the IRA would still be deferrable until you get the money back at the end. If you don't get the deduction, however, you might want to consider, of course, a traditional IRA versus a Roth IRA type of consideration. But you still may get benefit in a tax benefit. It just won't be as explicit in the point in time that you put the money in, but you could get a tax benefit in the growth of the funds as hopefully they increase over time, being in a savings account with interest or in some type of investment account where you might get dividends or capital gains or something like that over the time that the money is in the investments, and then at the point of distribution, you'd have to pay taxes. So you would be able to defer the amount of gain, the amount of increase in value in that case. However, of course, you probably would want to consider the point that if you're at that limit, then you may want to convert over to some other type of retirement, possibly a Roth IRA rather than a traditional IRA. Let's go back to the text. Example, Tony is 29 years old and single. In 2018, he was covered by a retirement plan at work. His salary is $67,000. His modified AGI adjusted gross income is $80,000. Tony makes a $5,500 IRA contribution in 2018. Because he was covered by a retirement plan and his modified AGI adjusted gross income is above $73,000, he can't deduct the $5,500 IRA contribution. So he put $5,500 in to the IRA, but he can't deduct the $5,500 because he has a limitation due to the amount of earnings he has, the AGI limitation. Back to the text. He must designate this contribution as a non-deductible contribution by reporting it on Form 8606. So here's a similar example. Here's 8606. So we've got the Form 1040, we've got the $80,000 of income, and we're saying that $5,500 was put into the IRA. We see that the software is not giving us the deduction because the software is saying, hey, you're over the amount. And we've got the 8606 then, the non-deductible IRAs is now being generated. There's the $5,500 that was contributed for which we did not get a deduction. Repayment of reservist distributions. Non-deductible contributions may include repayments of qualified reservist distributions. For more information, see qualified reservist repayments under how much can be contributed earlier. Form 8606, to designate contributions as non-deductible, you must file Form 8606. You don't have to designate a contribution as non-deductible until you file your tax return. When you file, you can even designate otherwise deductible contributions as non-deductible contributions. You must file Form 8606 to report non-deductible contributions even if you didn't have to file a tax return for the year. Caution: Form 8606 isn't used for the year that you make a rollover from a qualified retirement plan to a traditional IRA, and the rollover includes non-taxable amounts. So we're not really talking about a rollover here. We're typically thinking about the amount that a rollover, meaning taking money out of one qualified type of retirement type of plan, rolling it over, putting it into another, which isn't typically another contribution, which is different. We're considering a contribution here that wasn't deductible but typically would normally, and the normal reason it would not be deductible is because of the AGI, some type of AGI limitation usually. Back to the text. In those situations, a Form 8606 is completed for the year you take the distribution from that IRA. See Form 8606 under Distributions, Fully or Partially Taxable in Publication 590B. Failure to report non-deductible contributions. If you didn't report non-deductible contributions, all of the contributions to your traditional IRA will be treated like deductible contributions when withdrawn. So note, that's going to be one of the major kind of benefits or differences here, of course. If you don't get the deduction, notice again the deal that we have with the IRS considering the deduction for IRAs. So we're back to a lower income. If we get this deduction, then the $5,500, the point is we're not paying taxes on it now, and at the end of the time period, when we take it out, that's the point in time that we typically would think that we would pay taxes on it. But if I don't get this deduction at the point in time that I put it into the IRA, then you would think that when I take it out of the IRA, then I shouldn't have the same tax treatment for it because I already paid taxes on it when I put it into the IRA. So in essence, you want to be able to tell the IRA, the IRS, and be able to designate and say, hey, these are contributions that were not deductible, and therefore hopefully you have favorable tax treatment when the money is pulled out because you didn't get the benefit on the front end and therefore shouldn't have to pay taxes on the distribution side of things. Back to the text. All distributions from IRA will be taxed unless you can show with satisfactory evidence that non-deductible contributions were made. And again, if you can do the tax planning before you put the distribution or the contribution into the IRA, you might want to consider then, if it's not going to be deductible, to put it into some other type of IRA. We'll discuss a Roth type of IRA may be a better situation because then you don't have as much of that kind of confusion, or that's one of the benefits of it. So if we're not going to get the deduction, then we might say, maybe the traditional IRA isn't the way to go. Maybe we put money into a Roth type of IRA or some other retirement type of benefit plan. Back to the text. Penalty for overstatement. If you overstate the amount of non-deductible contributions on your Form 8606 for any tax year, you must pay a penalty of $100 for each overstatement unless it was due to reasonable cause. So there's going to be penalties for the overstatement. Penalty for failure to file 8606. You will have to pay a $50 penalty if you don't file a required Form 8606 unless you can prove that the failure was due to reasonable cause. Tax on earnings and non-deductible contributions. As long as contributions are within the contribution limits, none of the earnings or gains on contributions, deductible or non-deductible, will be taxed until they are distributed. So again, you can see that you still have some of the benefit. You might still benefit there by putting the money into the retirement plan, because hopefully the idea would be that you're going to put the money in, even if you don't get the deduction here, then you'll say, hey, that was a distribution that was I didn't get a benefit on it, and then hopefully when you get the money back at the distribution, you don't have to pay taxes on the amount that you contributed in it, and you still get the deferral hopefully of the earnings as it grows. So whatever's in the IRA as it grows, hopefully it grows. Hopefully the investments are doing well. Then typically you would be paying interest dividends on it. As the earnings happen, you'd be paying taxes on those. Typically you don't. If it's within a traditional IRA type of account, you don't pay those taxes until the point in time of distribution. So you still get some benefit, possibly the deferral of the gains on the investment, things like interest dividends, possibly other gains like capital gains. Back to the text. Cost basis. You will have a cost basis in your traditional IRA if you made any non-deductible contributions. Your cost basis is the sum of the non-deductible contributions to your IRA minus any withdrawals and distributions of non-deductible contributions. Caution: commonly distributions from your traditional IRAs will include both taxable and non-taxable cost basis amounts. So if you get a distribution, then again, this is going to kind of confuse things, because now you're thinking about your IRA, which has a cost basis in it, and that would be like the investment amount possibly, or the amount that you may not have to pay taxes on. So part of the distribution then is more complex. When you pull the money out, part of it might be taxable and part of it may not be taxable based on the fact that you put money into it, and some of it was non-deductible at the point of time that it was put into it. If you can separate the two, if you can say, hey, my traditional IRA is basically all deductible contributions, and my Roth IRA is a different type of IRA, then, and you can keep those totally separate, it might be easier to consider. And note, as you do this, you're considering in retirement time, a couple things you want to consider during retirement time. One, you want to maximize the amount that you can take out, and so it would be nice if you can take some out of a traditional IRA you might have to pay taxes on, and some out of something like a Roth IRA or some other investment that you wouldn't pay taxes on, so you can live off a good wage or a good amount of money without paying taxes on the whole thing, possibly. And two, you want to consider ease of taking the money out. We're going to be old. We're not going to be thinking that well, right? And our whole lives, we might have been putting this money into a W-2 fund. We're not used to doing tax planning where I got to figure how much tax I'm going to pay every time I pull money out. So we also want to make the tax calculation in terms of pulling money out and paying taxes, or how we're going to figure out how much tax we owe and that kind of thing, fairly easy. So we can, once we're pulling money out, do that without too much trouble, hopefully. In this presentation, we will take a look at some examples, worksheets for reduced IRA deduction for 2018. This information can be found in publication 590A. Example 1. For 2018, Tom and Betty file a joint return on Form 1040. They are both 39 years old. They are both employed. Tom is covered by his employer's retirement plan. However, Betty isn't covered by her employer retirement plan. Tom's salary is $62,000 and Betty's is $33,500. They each have a traditional IRA, and their combined modified AGI, adjusted gross income, which includes $9,000 interest and dividend income, is $104,500. Because their modified AGI is between $101,000 and $121,000, Tom is covered by an employer plan. Tom is subject to the deduction phase-out discussed earlier under limit if covered by employer plan. So we have a situation where they're putting money into the IRA. We've got some situation where there is a retirement plan, and therefore we're in the phase-out kind of limitation of income. So putting money into the retirement plan, we've got a phase-out type of limitation that needs to be dealt with in that case. For 2018, Tom contributed $5,500 to his IRA, and Betty contributed $5,500 to hers. So they went for the maximum. They contributed the maximum and said, hey, I'm going to try to put the maximum in, see if I can get that. But of course, they're going to be subject to this phase out. And what that means is that some of it is going to be deductible. Some of it will not be deductible. But the $5,500 has already been put into the IRA. So you can't really take the money out, or maybe you don't want to. It'd be difficult to remove the money. It's already been put into the IRA. You're only going to get the deduction for part of it. You're not going to get the deduction for the other part, but you still may get a tax benefit for it. So it's not a problem, really, but you're going to have to figure out the amount that's going to be deducted in that tax year. And you also got to figure the amount that is non-deductible and report that. And you need to report that on the form 8606, non-deductible IRAs. And that's going to be important, because that's going to help us to track the amount that we didn't get a benefit for on the front end when we put the money in, and therefore shouldn't be taxed on the distribution side. Tom can take a deduction of only $4,538 using worksheet 1-2. Figuring your reduced IRA deduction for 2018, Tom figures his deductible and non-deductible amounts as shown on worksheet 1-2, figuring your reduced IRA deduction for 2018, example 1. he can choose to treat the $4,538 as either deductible or non-deductible contributions. So note that he put in $5,500, going to be limited to this $4,538. The difference between the two does not get a deduction for it, and therefore must treat it as non-deductible contributions. However, and that difference, of course, is the $962 as we see here. However, can choose to, if they would like to choose to, treat more than that as the non-deductible contribution. You might say, well, why on earth would I do that? In this case, you may not want to do that because you want to get the deduction, but it might be the case where, for whatever reason, you're not paying much tax in this current tax year, and you already put the money into the IRA, and you might say, well, maybe I would rather pay the tax now and not pay it later on, and I already put the money in there. So I'll decide at this point in time to not get the deduction now and possibly get a benefit later on. So you could imagine a situation where that election could come in to be beneficial. Back to the text. He can either leave the $962, $5,500 minus the $4,538 of non-deductible contribution in his IRA, or withdraw them by April 15th, 2019. So it could be the case that he says, messed up. I can only put in $4,538. I'm going to withdraw it before April 15th and possibly put in the proper amount, or withdraw just the amount that is needed. But if that's not the case, if he decides, I'm just not going to do that, then we would say, okay, well then that's not a big deal, because we can then figure the difference and make it a non-deductible contribution. He decides to treat the $4,538 as deductible contributions and leave the $962 of non-deductible contributions in his IRA. So he leaves it in there. Betty figures her IRA deduction as follows. Betty can treat all or part of her $5,500 contribution as either deductible or non-deductible. So she has that same option. She can put it in there as deductible or non-deductible. She's not subject to the limitation. Probably put it in there considering that she was going to take it as deductible, but still has the option to make it non-deductible if she'd rather not have the benefit now, possibly have the benefit of not being taxed at the point of distribution, as opposed to being taxed at the point of distribution. Back to the text. This is because she isn't covered by her employer's retirement plan, and their combined modified AGI, adjusted gross income, isn't between $189,000 and $199,000. Therefore, she isn't subject to the deduction phase-out discussed earlier under limit if covered by employer plan, and she doesn't need to use the worksheet 1-2. Her situation's easy for her side of things. You can deduct the $5,500, or you can choose not to. Typically, people choose the deduction. Betty decides to treat her $5,500 IRA contribution as deductible. The IRA deductions of $4,538 and $5,500 on the joint return for Tom and Betty total $10,038. Example 2. For 2018, Ed and Sue file a joint return on Form 1040. They are both 39 years old. Ed is covered by his employer retirement plan. Ed's salary is $45,000. Sue had no compensation for the year and didn't contribute to an IRA. Sue isn't covered by an employer plan. Ed contributed $5,500 to his traditional IRA and $5,500 to a traditional IRA for Sue, a K. Bailey Hutchison spousal IRA. So notice we got that situation where uneven income, one spouse, in this case working, the other is not, may be able to contribute then in that case due to the K. Bailey Hutchison spousal IRA. Back to the text. Their combined modified AGI, which includes $2,000 interest and dividend income and a large capital gain from the sale of stock, is $188,555. Because the combined modified adjusted gross income AGI is $121,000 or more, and Ed is covered by his employer's plan, he can't deduct any of the contribution to his traditional IRA. He can either leave the $5,500 of non-deductible contributions in his IRA or withdraw them by April 15th, 2019. So in this case, he put the $5,500 in, determined because of the AGI or modified AGI, adjusted gross income limitation, can't deduct it. It's already been put in there. However, what are you going to do? Well, you could take it out before the due date of April 15th, 2019, or you can leave it in there and it won't be deductible, but you still may get a benefit as a non-deductible type of contribution. In this presentation, we will discuss the question of, what if you inherit an IRA? This information can be found in publication 590A. If you inherit a traditional IRA, you are called a beneficiary. A beneficiary can be any person or entity the owner chooses to receive the benefits of the IRA after he or she dies. Beneficiaries of a traditional IRA must include in their gross income any taxable distributions they receive. And of course, that's going to be the key point here. So we can imagine if we are inheriting the IRA. So if someone dies, they're going to say, okay, I need to leave the IRA. I've got this money. And remember, the money is considered to be in some type of account. We can consider it typically to be in some type of investment account, which is under the umbrella of an IRA. In other words, it might be in a savings account. It might be in a stocks and bonds types of accounts, some types of investments, those being one of the typical types of investments. Could be in other types of investments, but it's under the umbrella of an IRA. And that would mean that there's typically weird tax consequences related to it, because the fact that it's in an IRA means that usually upon distribution of the funds, if they were still alive, they would have to pay taxes on it at that point in time. But they died, and then of course they left the money that are in those funds, possibly, to someone who's going to inherit that money, the beneficiaries. Now the beneficiaries have this money that is in what was an umbrellaed IRA account. What do they do with that money when it wasn't them that put it into the retirement account? So the key phrase here is what do we do with taxes? I mean, how's the IRS going to deal with this for us? Do we have to pay taxes on it? And the point being here, beneficiaries of a traditional IRA must include in their gross income any taxable distributions they receive. Inherited from spouse. If you inherited a traditional IRA from your spouse, you generally have the following three choices. You can do one of the following. So now we inherited from the spouse. So we have a married couple, one of the spouses dies, and therefore the IRA is then inherited by the other spouse. Three options. One, treat it as your own IRA by designating yourself as the account owner. So we can, in essence, treat it as our IRA. Two, treat it as your own by rolling it over into your IRA, or to the extent it is taxable into a, so we got a rollover basically. We could say, in essence, we can say the IRA is basically ours, because notice it's another account that was in someone else's name, but they were our spouse possibly, so they were our spouse. So then now the question is, well, how are we going to deal with this at this point in time if we inherited it? Well, basically, again, you can treat it as your own IRA by designating yourself as the account owner, but we might want to just roll it into another type of account. We might want to manage the investments in those accounts in some other account, and therefore we might want to do a rollover. So two is treat it as your own by rolling it over into your IRA, or to the extent it is taxable into a qualified employer plan, B, qualified employee annuity plan, section 403A plan, C, tax shelter annuity plan, section 403B plan, or D, deferred compensation plan of a state or local government, section 457 plan. 3, treat yourself as the beneficiary rather than treating the IRA as your own. Treating it as your own. You will be considered to have chosen to treat the IRA as your own if. So you might be asking, what does that mean to treat it as my own? So yeah, these will be the conditions. So let's read that one more time. You will be considered to have chosen to treat the IRA as your own if contributions, including rollover contributions, are made to the inherited IRA, or you didn't take the required minimum distribution for a year as a beneficiary of the IRA. You will only be considered to have chosen to treat the IRA as your own if you are the sole beneficiary of the IRA and you have an unlimited right to withdraw amounts from it. However, if you receive a distribution from your deceased spouse's IRA, you can roll that distribution over into your own IRA within 60-day time limit, as long as the distribution isn't a required distribution, even if you aren't the sole beneficiary of your deceased spouse's IRA. So that would be a kind of an unusual type of situation, but it's possible that we had a distribution from the spouse's IRA and we say, I didn't want the distribution from the IRA. I don't need it right now. And so you can possibly put it back in as long as you do so within the 60-day time period and thereby not reporting it as a distribution and possibly not paying the taxes on it. Back to the text. For more information, see When Must You Withdraw Assets, Required Minimum Distribution in Publication 590B for more information on required minimum distributions. Inherited from someone other than the spouse. So what if we inherited it from someone other than our spouse? If you inherited a traditional IRA from anyone other than your deceased spouse, you can't treat the inherited IRA as your own. So we can't just do the same type of treatment possibly that we could as if we inherited from our spouse. So we don't have as many options in that format. Back to the text. This means that you can't make any contributions to the IRA. It also means you can't roll over any amounts into or out of the inherited IRA. So we're much more restricted in this situation in terms of putting more in, rolling money in or out of it. However, you can make a trustee-to-trustee transfer as long as the IRA into which amounts are being moved is set up and maintained in the name of the deceased IRA owner for the benefit of you as beneficiary. So you could see publication 590B for more information. So you can see how this can kind of be more of a problem. They're saying if it's a married couple, you can see where they'd be saying, because if you think about this situation, you're saying, they got a deduction. We got a deduction for the IRA. And now it's a point of distribution. You would think at the point someone dies, that hopefully they lived a long life and they're going to die and they have money in the IRA. Well, if you give it to your spouse, then you're going to give more benefits to that because you would think the spouse would be a similar age range normally under normal conditions, and you could give similar benefits to rolling that over. But you could see how the IRS, and this is me interpreting the law here, trying to give some reason as to why this could be, so it helps us to memorize it or think about it. If you were to give it to someone other than the spouse, you might give it to a child or something like that, who clearly isn't close to retirement. And you could see how the IRS would be skeptical about that. They wouldn't like that because the whole point is you put money in now, and then when you get to retirement age, you take it out, and that's when we take your money. So we won't take your money now, but when you get old and you take the money out, that's when we take it. But then if you die and you inherit it to a kid who's not going to take it out for another, 50 years, the IRS is like, that's too long for the defer being able to take. So they're going to restrict that more. So you can see how the law would be more restrictive if someone inherited money, and it wasn't the spouse. They're going to try to possibly put more restrictions on because we've already got the benefit of the deferral, and the IRS wants to get their money sometime. You can kind of imagine that situation. Back to the text. Like the original owner, you generally won't owe tax on the assets in the IRA until you receive distribution from it. You must begin receiving distributions from the IRA under the rules for the distributions that apply to beneficiaries. For more information about rollovers, required distributions, and inherited IRAs, see Rollovers Later under Can You Move Retirement Plan Assets, When Must You Withdraw Assets, Required Minimum Distribution in Publication 590B. And note here, of course, we're combining the two items here because we're thinking about the distribution side to some degree. So whenever we think we're concentrating here on the contribution side, when do we get the deduction? But as we do so, we have to have some frame of reference of what's going to happen on the distribution side because we need to know some idea of the big picture. But of course, when you consider the full picture of distributions, there's a whole other range of topics that you can consider various types of situations. And for that, you would want to go and concentrate on the distributions, which can be found publication 590B. Go to the IRS website, irs.gov, type in pub or publication 590B. The distribution of IRA beneficiaries under When Must You Withdraw Assets, Required Minimum Distributions, again in publication 590B. In this presentation, we will discuss the question of, can you move retirement plan assets? This information can be found in publication 590A. You can transfer tax-free assets, money, or property from other retirement programs, including traditional IRAs, to a traditional IRA. You can make the following kinds of transfers. So if we consider this item, what we're thinking here is, all right, we've set up an IRA or we've set up some type of retirement program. Possibly we have different types of retirement programs. We're thinking about past contributions that have already been made to them. When we put the money into the retirement program, we're typically looking for the deduction at the point in time that we put the money into the IRA. Once it's in there, then it's stuck. It's going to be stuck in the IRA. We can't take it out, in essence, unless there's some kind of unusual circumstance until the point of retirement. Otherwise, we may be penalized on it. But what if I do something and I go somewhere else and I want to change my IRA account? For example, we might go to a different type of institution, financial institution, and we might want to put our investments in a different type of institution, or we might have a different type of IRA or retirement type account altogether. In that case, we might want to roll over what's already been in the IRA. And our objective there, note, would be that, look, I already have the IRA set up. I don't want to make another distribution. I just want to move this money and investments from here to over here. And I don't want to be taxed on it from the rollover. Part of the problems with an IRA is we're restricted in some ways to roll over because we want to make sure that we do so without having it qualify as being taken out and thereby being subject possibly to penalties. So our goal then is to say, hey, this is a rollover. I'm just taking it out of something that's going to be a retirement type of account, possibly putting it into some other type of retirement account, which is also under the umbrella of some type of retirement account and therefore isn't a contribution or distribution, therefore not subject to tax, but also not subject to amount that's going to be deducted as well, because it's not a distribution or a contribution. It's just a rollover from one account to the other. Back to the text. If we have a transfer from one trustee to another, rollovers, and transfer incident to a divorce. This chapter discusses all three kinds of transfers. In this presentation, we will discuss trustee to trustee transfer, which is one of the ways we can think of moving the retirement plan assets. This information can be found in publication 590A. So we have the trustee to trustee transfer. This is one of the type of situations where we may be taking the investment out of one type of retirement account into another, basically going from one trustee that was a qualified trustee and then putting the investments in for another trustee. So we have the trustee to trustee transfer. A transfer of funds in your traditional IRA from one trustee directly to another, either at your request or at the trustee's request, isn't a rollover. This includes the situation where the current trustee issues a check to the new trustee but gives it to you to deposit. Because there is no distribution to you, the transfer is tax-free. Because it isn't a rollover, it isn't affected by the 1-year waiting period required between rollovers. This waiting period is discussed later under rollover from one IRA to another. So we're getting a little bit technical on the language in terms of what's going to be a rollover, what's not a rollover, or what's going to be included as something that's taxable or not. You can consider if we had a trustee and a trustee, if we have two institutions, one being the trustee for the IRA and the other one is where you want it to go to, and the second trustee. And we can consider, of course, us down here. Well, we can consider the situation. How would this happen? Maybe they give us the money and we put it into the new trustee account. But typically, we don't really want to do that usually because it might be better or faster or easier, and we don't have to basically worry about the compliance for us to take it out and then put it back in if we were just to have a trustee to trustee transfer, taking it directly from one to the other. And that way there can't be really any confusion. You may still hear that referred to as a rollover in some cases, but just note that the goal of it here is, of course, to make sure that it goes from one trustee to the another trustee and that it qualifies as not another, basically a distribution. It's not a distribution. It's not a contribution. We're going directly from one trustee to the other. For more information about direct transfer from retirement programs other than traditional IRAs, you can see the direct rollover options later. In this presentation, we will discuss the topic of rollovers with regard to the question of, can you move retirement plan assets? This information can be found in publication 590A. Rollovers. Generally, a rollover is a tax-free distribution to you of cash or other assets from one retirement plan that you contribute to another plan within 60 days you receive the payment or distribution. So notice that technically this is going to be the actual rollover that we think of. When we consider this option, we know that we're moving from one retirement account to another. So you'll often hear that in a terminology of trying to say, hey, look, I'm rolling it over, as opposed to a distribution and then contribution. That's really what we're looking for. The most complication, so one of those items, one way we can think of that is basically a transfer that's not going to involve the taxpayer, right? It's not going to go to the taxpayer. That way there's no confusion. And so if there are two, an IRA here and an IRA here, and we want to go from here to here, and then we're the taxpayer, the easiest way or the most straightforward way is to transfer, just straightforward, go from one to the other without taking ourselves getting our hands on the money. And if we did that, that would be one of the most straightforward kind of ways to basically indicate for sure that, look, we didn't take a distribution or a contribution. It's not a contribution distribution. It's just going to be basically a transfer. If we're taking a look at a rollover situation, then it's a point where we could get the money, right? We got the IRA here or the type of retirement account. We're taking it out of one. We now have it, but we're saying, hey, look, we're not holding on to it. It's going to be a rollover, and we're going to put this back in to another retirement account. Note, as you do this, you want to consider and make sure that as much as possible that the documentation related to the distribution, you're going to get a 1099 distribution. It might look at something like this, where we have the distribution for the 1099-R, distributions from pensions, annuities, retirement, or profit sharing. Now, note that if it's going to be something that's not taxable, if they're still reporting it to us, it would have to be indicated with the distribution code down here, saying that, look, it's not a taxable item. This is going to be a non-taxable item if it needs to be reported at all. In other words, if you get a 1099 and it's miscategorized, they call it a normal type of distribution with the code, rather than it being some type of rollover or something that qualifies as a transfer or some type of distribution like that, the IRS will assume then that it is a distribution that should be taxed, whereas in reality it needs to be a rollover or something like that. So if you do have the rollover and if the money goes to you in particular, and then you're going to put it back into another IRA, you want to be very clear with the institution that is giving you the money that it is hopefully not reported on a 1099 as a normal distribution, in which case the IRS will think that you owe money on it. You really want them to be giving you, if they give any 1099 form, to report a potential income or potential type of distribution in the form of the correct distribution code, which would then indicate a rollover as opposed to some type of taxable distribution. Back to the text. The contribution to the second retirement plan is called a rollover contribution. So then when we put the money into the second plan, it's going to be a rollover contribution. So obviously it might be much more than the $5,500 we've been talking about for the upper limitation, but you're not going to get the deduction for it. We're not looking for an item that's going to be giving us the deduction. We took it out, we put it back in. It's not going to give us the IRA deduction here because it's just a rollover. We already had it in a retirement plan. We already got the benefits of putting it in there at the point in time we put it in there. If we got any benefits from that at all, that's when they should have happened. Now it's just rolling over from one to the other so we can hold on to it until the point of distribution. Note, an amount rolled over tax-free from one retirement plan to another is generally included in income when it is distributed from the second plan. So what this means, of course, is we have the one retirement plan and we took it out, but then we put it back in within the time period, and therefore it's a rollover distribution. It wasn't a distribution at this point in time. It's not going to be included at this point in time, but we will have to take it out at some point. Now that it's in the second retirement plan, we'll be required to take it out sometime when we, at the age of retirement, hopefully we last and put it in there at that until then. And then when we take it out, that's when it's usually going to be the distribution that will then be subject to tax, as would normally be the case under a traditional type of IRA or retirement plan. Kinds of rollovers to a traditional IRA. You can roll over amounts from the following plans into a traditional IRA. So we're considering a traditional type of IRA here. Now, note you could have different types of situations with different other types of plans that you want to possibly roll over into a traditional type of IRA, because of course there are many different types of retirement plans. So of course you can roll over a traditional IRA to a traditional IRA. Those are like accounts, so that would be pretty straightforward, that you would think that that would be the case. You can roll over an IRA to an IRA. An employer's qualified retirement plan for its employees. And this is often the case, of course, because you might have a situation where you work somewhere and then you leave and they had a retirement plan and they were managing it or whatnot, and you're not there anymore and you want to get your money. What you don't want to do is basically just give me the money, because then you're going to get penalized on it because it was in a retirement plan and you're going to be penalized for taking the money out. In that situation, you might want to make sure, in essence, that you take it out and put it back into an IRA possibly, or if you can set up a direct transfer, then that would be good too. But you want to make sure to put it into the IRA, and that would be a common type of situation, a common error that people make, that people get caught up in too, is that they take the money out of the retirement account when they leave a place of employment, because they just want to be done with that, and move their money, instead of rolling it over and then get subject to paying income tax on it, as well as possibly penalties for an early distribution. So make sure that's a common thing to look at. And then a deferred compensation plan of a state or local government, a Section 457 plan. So you might say, well, what if I don't have a 401k plan, which is a typical plan that you would have possibly in an employer-employee situation at a company. If you work for the state, you might have some other type of plan under Section 457, works in a similar way. We have the similar condition. If we stop working for the state, we might have money in it. We would like to roll over to something like an IRA. And then a tax shelter annuity plan, a Section 403 plan, similar situation. We can also see Table 1.4 for more of those items, or for more information related to them. Treatment of rollovers. You can't deduct or roll over contributions, but you must report the rollover distribution on your tax return, as discussed later under reporting rollovers from IRAs and reporting rollovers from employer plans. So note that the benefit of the rollover is, of course, that we don't have to report it as a distribution, pay taxes on it, and a kind of contribution that we don't get the benefit of the contribution. But typically, we still do have to report it, and that typically means that the IRS is going to often require the person that is distributing the money to give some type of documentation, possibly a 1099-R. And again, distribution code 1099-R, make sure it's correct. Otherwise, it's causing problems with the IRS, big headaches. Back to the text, rollover notice. A written explanation of rollover treatment must be given to you by the plan other than an IRA making the distribution. See written explanation to recipients later for more information. Kinds of rollovers from a traditional IRA. You may be able to roll over tax-free a distribution from your traditional IRA into a qualified plan. These plans include the Federal Theft Savings Fund for federal employees, deferred compensation plans of state and local governments, Section 457 plans, and tax shelter annuity plans, Section 403B plans. The part of the distribution that you can roll over is the part that would otherwise be taxable, includable in your income. And that, of course, would make sense if you're thinking about these types of plans. The amount that would be, the amount that would roll over from one plan to another, if you have part of the plan that would be taxable and part that would not be taxable, you would think then that the part that would be taxable upon distribution is the part that you can roll over to another IRA. And that's what you want to have happen, because that's the part that upon distribution you're going to pay taxes on, because you got a benefit when you put it into the IRA. So what you don't want to do, of course, is if you have money in some type of savings plan that is not subject to tax upon distribution, to then roll it over into an IRA and then pay taxes on it when you didn't get the benefit on the front side when you put it into the plan. So back to the text. Qualified plans may be, but aren't required to, accept such rollovers. Tax treatment of a rollover from a traditional IRA to an eligible retirement plan other than an IRA. Ordinarily, when you have basis in your IRAs, any distribution is considered to include both non-taxable and taxable amounts. Without a special rule, the non-taxable portion of such a distribution couldn't be rolled over. However, a special rule treats a distribution of rollover into an eligible retirement plan as including only otherwise taxable amounts if the amount you either leave in your IRAs or don't roll over is at least equal to your basis. The effect of this special rule is to make the amount in your traditional IRAs that you can roll over to an eligible retirement plan as large as possible. So note, as you think about this, there's a couple conditions that can be a little bit confusing. And again, part of the confusing topic will be if you're talking about a retirement plan that has both taxable portion upon distribution and a portion of it which is not taxable upon distribution, because again, you didn't get the benefit when you put it into the retirement plan. So if that's the case, and you want to be careful on the regulations for the rollover. Back to the text. Eligible retirement plans. The following are considered eligible retirement plans. You got the IRAs, the qualified trusts, qualified employee annuity plans under Section 403B, deferred compensation plans of state and local governments, Section 457 plans, tax shelter annuities, Section 403B, annuities. So note, when you consider all of these type of plans, you can consider them, they're all kind of in the same boat, right? And so when we consider an IRA, what we're basically saying is we want to get a tax benefit by putting money into a restricted thing for retirement, getting the benefit now, and then having to pay taxes on it later. And many times this type of benefit traditionally happens through work, through employment that provides some type of plan. And then if you talk about state governments or government plans, they have their benefit plan in some special code section because they're the state, because of their government. But they're all similar in nature. So, and basically the IRA would be there for those time periods when you don't have another plan to put in place. Because usually you have another plan. If you have an employer plan or something, you can usually put more money into it. But if you don't have an employer plan, then you have an IRA, which is kind of like the default. So it's like the same thing, but now it's for somebody that doesn't have an employer that has a qualified plan. The employer's plan is probably better because it usually has a higher limit to put money into. The IRA also, of course, works very well because then if you leave some of these areas that has a 401k or some kind of retirement plan, and whether it be the state or the Fed, all the same similar kind of benefit plans, they just have different amounts of qualifications and whatnot and how much you can put in. But from a tax standpoint, they're similar in when you're going to be paying the taxes. The IRA then is great because when you leave those situations or those places of employment, then possibly you can roll the money over and not have any problems, hopefully, in doing so. In this presentation, we will discuss the time limit for making a rollover contribution. This information can be found in publication 590A. Time limit for making a rollover contribution. You generally must make the rollover contribution by the 60th day after the day you receive the distribution from your traditional IRA or your employer's plan. So when we're considering the rollover type of situation, notice what we have here. We've got our IRA or one type of retirement plan. We want to put it into some other type of retirement plan, and this is us. We're the taxpayer. And typically we want to take it out of this one. We're not going directly over, which would be nice if we could do so, because then we don't have any kind of the problems. But if we're taking the money out here and we're going to put the money back in, then in essence, we're in the same situation in terms of the types of retirement accounts, and we're considering the time limits with regard to that rollover situation, with regard of the money going from one account to the other, with regard to having some type of rollover that's not considered a distribution and a contribution, but simply a rollover without the tax effects of the distribution or the tax benefits of a contribution. Back to the example, back to the text, example 1. You receive an eligible rollover distribution from your traditional IRA on June 30th, 2018 that you intend to roll over to a 403B plan. So we got the 403B plan, we got an IRA, it's going into a 403B plan. So that might be a situation, if you're imagining this situation, we were not employed before, we had an IRA possibly, or we had an IRA for some situation. Maybe we go into some state government or a government type of job where we have a 403B, which is, you might think of like a kind of a 401k for a type of government type of job. And in other words, some type of retirement type of plan. We want to take the money out of our normal retirement plan that we had, our IRA plan, and that we already got the tax benefit from it and put it into this 403B so it can be managed within the 403B with, the other 403B funds that we're going to have. So we need to roll it over there. Back to the text. To postpone including the distribution in your income, you must complete the rollover by August 29th, 2018, the 60-day following June 30th. So just make sure to do that. Make sure that you complete that rollover process, taking it out, rolling it back over within the time period so that it will count for a rollover and not a distribution or contribution. Back to the text. The IRS may waive the 60-day requirement where the failure to do so would be against equity or good conscience, such as in the event of a casualty, disaster, or other event beyond reasonable control. So if you have some type of good excuse, you could try to give the good excuse, but you'd rather not do so. You'd rather make sure that you're within the waiting period and have no need for any type of excuse, no matter how good it may be. Back to the text. For exceptions to the 60-day period, see ways to get a waiver of the 60-day rollover period later. So if you've already in a situation where you're past the 60-day rollover period, you can look up the type of exceptions that you may qualify under for. Plan loan offset. A plan loan offset is the amount your employer plan account balance is reduced or offset to repay a loan from the plan. So it's possible we have a loan out on the plan, and so we need some plan offset in that case, if that's the case that you are currently in. Back to the text. How long you have to complete the rollover of a plan loan offset depends on what kind of plan loan offset you have. For tax years beginning after December 31st, 2017, if you have a qualified plan loan offset, you will have until the due date, including extensions, for your tax return for the tax year in which the offset occurs to complete your rollover. A qualified plan loan offset occurs when a plan loan is in good standing, is offset because your employer plan terminates or because you sever from employment. If your plan loan offset occurs for any other reason, then you have 60 days from the date the offset occurs to complete your rollover. Rollover is completed after the 60-day period. So what if we have the rollover after the 60-day period? Back to the text. In the absence of a waiver, amounts not rolled over within the 60-day period don't qualify for tax rollover treatment. That's not good. So that means we might have to call it a distribution, and we could be penalized. Back to the text. You must treat them as taxable distributions from either your IRA or your employer's plan. These amounts are taxable in the year distributed, even if the 60-day period expires in the next year. You may also have to pay a 10% additional tax on early distribution as discussed under Early Distributions Pub 590B. So just note that we're talking about the distribution side kind of because we're thinking about the rollover as opposed to a contribution. So for more information on the distribution kind of information, publication IRS website, irs.gov, publication 590B. So just remember, you really want to keep within the 60-day time period. Why? Because if you don't, then we didn't pay taxes on it when we put the money in. And if we have a lot of money in there and we just take it out, we're going to have to pay taxes on it. Not only that, but we took it out early in violation of the rules for the IRA. The reason that the IRA set up the situation in the first place was that we don't take it out, and therefore they could even penalize us and tax us on it, which isn't good, isn't nice, not something we want. Back to the text. Unless there is a waiver or an extension of the 60-day rollover period, any contribution you make to your IRA more than 60 days after the distribution is a regular contribution, not a rollover. So if you waited past the 60-day time period, no longer really is it a tax-free distribution. It's a taxable distribution, possibly subject to penalties. And if you put it back into another IRA, then no longer is it a rollover contribution to the plan, contribution to the new plan, but and just a normal type is going to be a contribution. It's going to be some type of contribution, not a rollover. Back to the text. Example, you receive a distribution in late December 2018 from a traditional IRA that you didn't roll over into another traditional IRA within the 60-day limit. Not good. You don't qualify for a waiver, so you went through the excuses and you don't have one that you think you can apply for. This distribution is taxable in 2018, even though the 60-day limit wasn't up until 2019. Ways to get a waiver for the 60-day rollover requirement. So if it's past the 60 days, you're considering how can I, possibly get a waiver for this. Here's how, possibly. Back to the text, there are 3 ways to obtain a waiver of the 60-day rollover requirement. You qualify for an automatic waiver. You self-certify that you met the requirements of a waiver. You request and receive a private letter ruling granting a waiver. How do you qualify for an automatic waiver? You qualify for an automatic waiver if all the following apply. The financial institution receives the funds on your behalf before the end of the 60-day rollover period. So maybe you gave them the money. You're like, the check was in the mail. They got the money before the 60-day. Second item, you followed all of the procedures set up by the financial institution for depositing the funds into the IRA or other eligible retirement plan within the 60-day rollover period, including giving instructions to deposit the funds into a plan or IRA. The funds aren't deposited into the plan or IRA within the 60-day rollover period solely because of an error on the part of the financial institution. So we're basically saying, hey, the check was there, the money was there, I did my part, I told them to put it into another IRA, the financial institution messed up. Well, then the IRS says that could possibly be a reason for a waiver. Back to the text. The funds are deposited into a plan or IRA within 1 year from the beginning of the 60-day rollover period, so it has to still be within some type of time frame. It would have been a valid rollover if the financial institution hadn't deposited the funds as instructed. So if we could basically, pin it on the financial institution, then or if it was a legitimate error on the financial institution and we did everything in our good faith to make it happen, then that could qualify for an automatic waiver. If you didn't qualify for an automatic waiver, you can use the self-certified procedure to make a late rollover contribution, or you can apply to the IRS for a waiver of the 60-day rollover requirement. So we can apply for a waiver in that case if we so choose. Or we can use the self-certified procedure to make a late rollover contribution. How do you self-certify that you qualify for a waiver? Pursuant to Revenue Procedure 2016-47 in Internal Revenue Bulletin 2016-37, available at IRB 2016-37, you may make a written certification to a plan administrator or an IRA trustee that you missed the 60-day rollover contribution deadline because of one or more of the 11 reasons listed in Revenue Procedure 2016-47. A plan administrator at the IRS trustee may rely on the certification in accepting and reporting receipt of rollover contributions. You may make the certification by using the model letter in the appendix to the revenue procedure or by using a letter that is substantially similar. So in essence, you got to basically make a request in accordance with the set format, and you may even be able to use the template type model letter in order to do so, to give the reasoning. The reasoning hopefully will be, you should look up the reasons and hopefully you comply with one of the 11 reasons listed in the Revenue Procedure 2016-47 to make the request. There is no IRS fee for self-certification. A copy of the certification should be kept in your files and be available if requested on audit. How do you apply for a waiver and what is the fee? You can request a ruling according to the procedures outlined in Revenue Procedure 2003-16 and Revenue Procedure 2018-4. The appropriate user fee of $10,000 must accompany every request for waiver of the 60-day rollover requirement. So you probably want to steer away from that one if at all possible, because to request it, we have the appropriate user fee of $10,000 must be accompany every request for a waiver of the 60-day rollover requirement. See the user fee chart in Appendix A of Revenue Procedure 2018-4. How does the IRS determine whether to grant a waiver in a private letter ruling? In determining whether to issue a favorable letter ruling granting a waiver to the IRS will consider all the relevant facts and circumstances, including whether the errors were made by the financial institution, that is, the plan administrator or IRA trustee, issuer, or custodian. So where was the problem happening? On the IRA side, the trustee side, or was it on the taxpayer side? Back to the text. Whether you were unable to complete the rollover within the 60-day period due to death, disability, hospitalization, incarceration, serious illness, restrictions imposed by a foreign country, or postal error. So that's the classic excuse, of course, is that one. But in any case, so there would be some kind of reasonable way or reason why it didn't happen. And these would be the ones that would be listed here that would be the most common, that probably have precedent and therefore might be the ones more likely to be applicable. And then whether you use the amount distributed and how much time has passed since the date of the distribution. Note, the IRS can waive only the 60-day rollover requirement and not the other requirements for a valid rollover contribution. For example, the IRS can't waive the IRA one rollover per year rule. So there's a one rollover per year rule. Can't waive that one. We're waiving only the 60-day issue. For more information on waivers of the 60-day rollover requirement, go to Retirement Plans, Frequently Asked Questions. Amount. The rules regarding the amount that can be rolled over within the 60-day time period also apply to the amount that can be deposited due to a waiver. For example, if you receive $6,000 from your IRA, the amount that you can deposit into an eligible retirement plan due to a waiver is $6,000. Extensions of rollover period. If an amount distributed to you from a traditional IRA or a qualified employer retirement plan is a frozen deposit at any time during the 60-day period allowed for a rollover, two special rules extend the rollover period. The period during which the amount is frozen is a frozen deposit isn't counted in the 60-day period. The 60-day period can't end earlier than 10 days after the deposit is no longer frozen. So we have some extensions in the case of that freeze, in essence, extending the time period with regard and relation to that freeze. Frozen deposit. This is any deposit that can't be withdrawn from a financial institution because of either of the following reasons. So here's what qualifies for a frozen deposit and this possible extension related to them. Here we go. The financial institution is bankrupt or insolvent. The state where the institution is located restricts withdrawals because one or more financial institutions in the state are or are about to be bankrupt or insolvent. In this presentation, we will discuss the situation of a rollover from one IRA to another. This information can be found in Publication 590A. Rollover from one IRA to another. You can withdraw tax-free all or part of the assets from one traditional IRA if you reinvest them within 60 days in some other traditional IRA. Because this is a rollover, you can't deduct the amount that you reinvest in an IRA. So in other words, we're thinking about a rollover situation. It's going from one IRA account to another. If we pull the money out, we got the two people here. We got the two IRAs, let's consider, and then we have ourselves. So if we take the money out and then put it into another IRA, we are in essence in the same situation. We don't want to be taxed on the distribution. That's the good thing. If we count it as a rollover, if we qualify and count it as a rollover, we don't have the distribution, not taxed on it. That's good. We also, of course, don't get the benefit of the contribution that we may get if we were to have a contribution into the other IRA. In other words, we wouldn't get a deduction like this if it was a rollover kind of transaction. So, and that's good anyways, because we're probably going to be rolling over more than the 5,500. Our point is that we don't want to be taxed on the distribution. So that's going to be a good thing. Tip: you may be able to treat a contribution made to one type of IRA as having been made to a different type of IRA. This is called a recharacterizing the contribution. See recharacterizations in this chapter for more information. So we'll talk more about that in a later presentation. That's going to be a bit more complex because you can see a situation like this where we're saying, hey, all I want to do is take it from one IRA to another IRA. I want to put it into possibly another account for whatever reason, possibly to have my assets be managed in a different way by a different group, by a different financial institution. However, if you get a little bit more complex, you might say, maybe I would like to put it from this type of retirement account into another. And the common two kinds of retirement accounts that are treated very differently for taxes is a traditional IRA and a Roth IRA. And so there could be, if we were able to recharacterize our type of retirement account from the treatment of different types of retirement accounts, then there's some different types of tax planning involved other than just us transferring money without it being taxed as it going out of the account as a distribution for tax purposes. Back to the text. Waiting period between rollovers. Generally, if you make a tax-free rollover of any part of a distribution from a traditional IRA, you can't, within 1 year period, make a tax-free rollover of any later distribution from that same IRA. You also can't make a tax-free rollover of any amount distributed within the same 1 year period from the IRA into which you made the tax-free rollover. The 1 year period begins on the date you receive the IRA distribution, not on the date you roll it over into an IRA. Rules apply to the number of rollovers you can have with your traditional IRAs. So note, the IRS is a bit skeptical about rolling over multiple times. It would look kind of funny. You would think that the rollover would happen and it would be kind of a one-time thing. If you had money in one IRA and you want to put it into another financial institution, you would think that would be kind of a one-time thing. If there was multiple rollovers happening in 1 year from the same accounts, that would look kind of funny possibly, and there's going to be possibly there's some abuse maybe at some point in time. I'm just speculating on why the law would be put out in the way it's going to be put out here with this restriction of the 1 year on the rollover. Example, you have two traditional IRAs, IRA 1 and IRA 2. In 2018, you made a tax-free rollover of a distribution from IRA 1 into a new traditional IRA, IRA 3. You can't, within 1 year of the distribution from IRA 1, make a tax-free rollover of any distribution from either IRA 1 or IRA 3 into another traditional IRA. For 2018, the rollover from IRA 1 into IRA 3 prevents you from making a tax-free rollover from IRA 2 into other traditional IRA. This is because in 2018, you are only allowed to make one rollover within a 1 year period. So when you make a rollover from IRA 1 to IRA 3, you can't make a rollover from IRA 2 to any other traditional IRA. So this can sound, of course, a bit confusing. We're talking about we have multiple different IRAs here, and we're rolling the IRAs over from one to the other. The concept being that, look, it's going from one tax IRA account that's already restricted under the same restrictions as another IRA account. I just want to roll it over to have it tax-free. I'm not looking for it to be taxed on the distribution. I'm not looking for any tax benefit on the contribution. But again, the IRS is going to limit that kind of information or those types of activities with this 1 year period for the rollover purposes. And again, part of that might just be to prevent any kind of confusion in terms of the reporting of the rollovers, or at least to limit the types of confusion. Exception: on IRA distributions made from a failed financial institution for the Federal Deposit Insurance Corporation as received is not treated as a rollover for purposes of the 1 year per year limit, provided 1. Neither the failed financial institution nor the depositor initiated the distribution, and 2. No financial institution has assumed the IRAs of the failed financial institution. So you could think of a situation where, like, well, what if the financial institution completely failed and I had to put, something had to happen at that point in time? Well, there could be an exception then to the 1 year period in that case. Application of 1 year, one rollover per year limitation. You can make only one rollover from an IRA to another, or the same IRA in any 1 year period, regardless of the number of IRAs you own. The limit will apply by aggregating all of the individual's IRAs, including SEP and Simple's IRAs, as well as traditional and Roth IRAs, effectively treating them as one IRA for purposes of the limit. However, trustee-to-trustee transfers between IRAs aren't limited, and rollovers from traditional IRAs to Roth IRAs conversions aren't limited. So note that if you have a direct transfer, a trustee-to-trustee transfer, then you may be okay, and that's probably what you want to do if you can do that anyways. That eliminates basically the confusion. If you could just go from a trustee to trustee, if a rollover technically that means we're taking it out. If we take the money out into our personal possession and then put it into another IRA, you could see why the IRS would get a little bit more concerned here. If we've got two type of retirement accounts and you just roll or you just transfer one to the other, then that's pretty straightforward. The money goes to one to the other. If the money then comes out to the taxpayer, and then the taxpayer puts it into another, especially if you have multiple IRAs, and then it goes to the taxpayer and the taxpayer puts money back into another, that gets kind of confusing. And you can see why the IRS would be skeptical of that type of situation. If you have the direct transfer from one to another and you eliminate the situation where the taxpayer is getting the money and then putting it back in to another type of account, that's probably the easier way to go, or the more transparent way to go most of the time. Example, John has 3 traditional IRAs, IRA 1, IRA 2, and IRA 3. John didn't take any distributions from his IRAs in 2018. On January 1st, 2019, John took a distribution from IRA 1 and rolled it over into IRA 2 on the same day. For 2019, John can't roll over any other 2019 IRA distribution, including a rollover distribution involving IRA 3. This wouldn't apply to a conversion. The same property must be rolled over. If property is distributed from an IRA and you complete the rollover by contributing property to an IRA, your rollover is tax-free only if the property you contributed is the same property that was distributed to you. So we can imagine this situation where you have an IRA and you're trying to get the money out of this IRA to the other, but what happened is there was a property distribution to the taxpayer, and then the taxpayer is going to put that back into the other IRA. Well, if it was property, then the IRS is saying you should put that same property into the other IRA. So it shouldn't be the case where the distribution happens and then you just say, oh, I'll take the property and then I'll put money back into the other IRA possibly. They're saying it should be the property. Back to the text. Partial rollovers. If you withdraw assets from a traditional IRA and you roll over part of the withdrawal tax-free and keep the rest of it, the amount you keep will generally be taxable except for the part that is a return of non-deductible contributions. The amount you keep may be subject to the 10% additional tax on early distributions discussed later under what acts result in penalties or additional taxes. So now we have the 2 IRAs and we're saying, okay, here, I'm the taxpayer, we pulled out, $10,000, let's say, and then we put back in only, $6,000. Well, now we have $4,000, of course, that we held on to. So the $4,000 then would be a distribution, and it wouldn't have been rolled over, and therefore it's going to be a distribution that might be early and probably subject to tax unless part of it was from income that we put in or money that we put into the IRA that we didn't get a deduction from at the beginning. But normally if it's in the IRA and we pull it out and it's a distribution, we're taxed on it if it's a traditional IRA. And if we pulled it out early, possibly we could have penalties on it, as well, as we'll discuss later. Required distributions. Amounts that must be distributed during a particular year under the required distribution rules discussed in Publication 590B aren't eligible for rollover treatment. So remember that there's this idea that if you reach retirement age, the deal is the IRS says, hey, you put money into the IRA, we don't tax you on that money when you put it in because you get this deduction. So you get this deduction. We don't tax you at that point in time. We don't tax you on the gains on it. So you make dividends and interest, that's good. But then when you pull it out, that's when we tax you, right? That's when we tax you. But we want that to happen. We don't want you to die and not, pull the money out, because then we never get to tax you possibly, and it gets more complicated. So they make you pull the money out in some required distribution. So at that point in time, if they're requiring you to distribute the money, they're doing that because they want to tax it. So they require you to distribute the money. They're not going to allow you to distribute the money and then put it back in to another IRA as if it was a rollover. That doesn't work. So you can't relabel a required distribution that the IRS forced us to do to pay taxes because they want some of it, and then call it a rollover and then not pay taxes by putting it back into another IRA. That doesn't work typically. So if it's a distribution, we gotta call it a distribution, probably be paying taxes on it. Inherited IRAs. If you inherit a traditional IRA from your spouse, you generally can roll it over or you can choose to make the inherited IRA your own, as discussed earlier under What If You Inherit an IRA. So we talked a bit about the inheritance in a prior presentation. Reporting rollovers from IRAs. Report any rollover from one traditional IRA to some or another traditional IRA on Form 1040, line 4A and 4B of Form 1040-NR, lines 17A and 17B. So if we have our mock 1040 here and we have our simple single individual, and we claim this to be a rollover, we might get, again, documentation on this. We might get the documentation saying, hey, a 1099 saying, look, a 1099-R typically that says you have a rollover, you have a distribution, and we're going to have to put that in the tax return. If we get reported on it, we should report it on the tax return. So we're going to say, all right, we got a rollover. Typically, it'll have a code, and the code might be something like a G in the code, as opposed to, if it was a 7 would be a normal distribution. So if you get a 1099 related to an IRA and it has a 7 on it, a normal distribution, and you think it should be a rollover, well then you really got to contact the institution, because they're going to be reporting that to the IRS, and it's going to be difficult to discuss with the IRS and say, hey, look, they reported the wrong code. What you really want to do is, as early as possible, change the code or get to the institution and say, hey, look, that should have been a rollover. Otherwise, you could have issues, with it. But in any case, if it's a rollover, then it's going to go to the form, and it'll be on 4A. So you can see here that we have the income from wages of $30,000, then the rollover distribution, but it's not included in total income on line 6. Why? Because it's a rollover. We're reporting it, not paying taxes on it, due to the fact of it being a rollover and not a distribution. Back to the text. Enter the total amount of the distribution on Form 1040, line 4A, or Form 1040-NR, line 17A. If the total amount on Form 1040, line 4A, or Form 1040-NR, line 17A, was rolled over, enter 0 on Form 1040, line 4B, or Form 1040-NR, line 17B. So in other words, we have the 10,000 here, but it's not here. So this is the information. This is the taxable, in essence, amount, the taxable amount as it says there, which is 0. Back to the text. If the total distribution wasn't rolled over, enter the taxable portion of the part that wasn't rolled over on Form 1040, line B, 4B, or Form 1040-NR, line 17B. Enter rollover next to the line 4B or line 17B. See your tax return instructions. If you rolled over the distribution into a qualified plan other than an IRA, or you make the rollover in 2019, attach a statement explaining what you did. For information on how to figure the taxable portion, see Are Distributions Taxable? You can see that in publication 590B. In this presentation, we will discuss a rollover from an employer's plan into an IRA. This information can be found in publication 590A. Rollover from employer plan into an IRA. You can roll over into a traditional IRA all or part of an eligible rollover distribution you receive from your or your deceased spouse's employer's qualified pension, profit sharing, or stock bonus plan, annuity plan, tax shelter annuity plan, Section 403B, or governmental deferred compensation plan, Section 457 plan. So we can imagine this type of situation. We're working at the employers, and we want to then transfer into a traditional type of IRA. And you can consider all these things kind of similar in nature. They have different requirements for when we can put the money in and how much money we can put in. But once the money is in these types of accounts, these types of retirement accounts, they are treated much the same in that it's in a retirement account. It's now there. We're restricted on taking it out, and typically the increase in the value of them, the gains, losses, dividends, interest, won't be taxable until the point in time we distribute them. So although they're different in terms of plans, they're different largely in terms of how much we can put into the plan at that point in time, who manages the plan, what are the requirements to put the distribution in. Once the distribution is in the plan, then it's basically a matter of how is the plan going to be administered in terms of just tracking the financial institution to see what the gains and losses and get at whatever reporting requirements are there. But then at distribution, that's the point in time that they're going to be taxed. So they're all similar in that sense to an IRA. So we should, once they've been contributed into, be able to roll it into some other plan that's under this kind of umbrella of just basically retirement type plans that are all treated similarly once the money is in them for tax purposes, and that'll allow us to transfer the money out. So that's the situation we're considering here. Might be a situation where we're leaving an employer or something like that, and we say, hey, I've got this money in the retirement account, I need to take it out. Well, don't just take it out, because then you're going to be taxed on it and possibly subject to a penalty for early distribution. What we want to do is put it into, in some format, some way, shape, or form, some other type of retirement account, possibly an IRA. So if we're working at a company, a larger company might have a 401k or some kind of pension type of plan, then we might want to take the money out of there when we leave, because that's managed by the company and we're not there anymore. So we might want to take it out and put it some other place. Hopefully that other place could be an IRA. If we're working for a government, then the plan's just called something else, like a 403B type plan or a 457 plan. These are all types of retirement plans, different kind of benefits with relation generally to the putting the money into the plan, depending on the different plan type. Once the money's in there, then it's treated much the same for tax purposes, and therefore can or hopefully should be able to be transferred to some other type of retirement plan, such as an IRA. Back to the text. A qualified plan is one that meets the requirements of the Internal Revenue Code. Eligible rollover distributions. Generally, an eligible rollover distribution is any distribution of all or part of the balance to your credit in a qualified retirement plan, except the following. 1. A required minimum distribution, explained later under When Must You Withdraw Assets. Required minimum distribution in Publication 590B. 2. A hardship distribution. 3. Any of a series of substantially equal periodic distributions paid at least once a year over A. Your lifetime or life expectancy, B. The lifetime or life expectancy of you and your beneficiary, or C. A period of 10 years or more. 4. Corrective distributions of excess contributions or excess deferrals and any income allocable to the excess or of excess annual additions and any allocable gains. 5. A loan treated as a distribution because it doesn't satisfy certain requirements either when made to or later, such as upon default, unless the participant's accrued benefits are reduced, offset to repay the loan. See the discussion earlier on plan loans offset, including qualified plan loans offset under time limit for making a rollover contribution. 6. Dividends on employer securities. And 7. The cost of life insurance coverage. Your rollover into a traditional IRA may include both amounts that would be taxable and amounts that wouldn't be taxable if they are distributed to you, but not rolled over. To the extent the distribution is rolled over into a traditional IRA, it isn't included in your income. So that's going to be the key point. When we put the money into the IRA, it's going to be a rollover, typically not included in our income. It's not a distribution. Now, remember that we might have some situation where part of the money in the retirement account is basically subject to tax upon distribution, but part of it might not be, depending on the type of retirement account. So when we think about the money going into a retirement account, we're getting the benefit, which is similar to basically a deduction, in essence, it not being taxed in some way if it's an employer plan. But we might have some money in there that we did pay tax on. And so when we roll it over, we have to basically make sure that we're tracking that, because when we pull the money out upon distribution, then we want to make sure that we're not paying taxes on any money that we don't have to pay taxes on. Back to the text. Tip. Any non-taxable amounts that you roll over into your traditional IRA become part of your basis cost in your IRAs. So that's going to be the cost portion. So if we roll it over, make sure it's rolled over correctly so that you have that cost broken out so that the manager of the IRA can then, upon distribution, properly break out the part of the distribution which is going to be the cost that possibly might not be subject to tax versus the part that is not cost, which is going to be subject to tax. Back to the text. To recover your basis when you take distributions from your IRA, You must complete Form 8606 for the year of distribution. You can see Form 8606 under Distributions Fully or Partially Taxable in Publication 590B. Rollover by non-spouse beneficiary. If you are a designated beneficiary other than a surviving spouse, so basically we're the beneficiary inheriting of a deceased employee, you can roll over all or part of the eligible rollover distribution from one of the types of plans listed above into a traditional IRA. You must make the rollover by a direct trustee to trustee transfer into an inherited IRA. You will determine your required minimum distribution in years after you make the rollover based on whether the employee died before his or her required beginning date for taking distributions from the plan. For more information, see distributions after the employee's death under Tax on Excess Accumulation in Publication 575. So if there's some type of inheritance, note that you have this question of, remember the IRS wants, what they don't want to see happen is that someone deferred all of the gain, as was the case, for retirement, and then that person died before they pulled the money out. They give it to someone else who then defers all the tax on it for their entire life, and possibly this goes on forever. That's not the deal. The IRS says, hey, you put the money in now, we give you a tax benefit, we give you a deferral until retirement time, and then you take that money out, and then we take it, right? That's the deal. You can't die and then give it to somebody else. So the question, so you always got that kind of issue, like what happens when you have required distributions and then someone dies and then you got the rollover. That's going to be concentrated more on the distribution side of things. We're here focusing a bit more on the contribution. We'll discuss the distribution from time to time, but note that you can go to a second publication to get more information on distributions, especially distributions with regard to if there's some type of inheritance. Written explanation to recipients. Before making an eligible rollover distribution, the administrator of a qualified retirement plan must provide you with a written explanation. It must tell you about all of the following: your right to have the distribution paid tax-free directly to a traditional IRA or another eligible retirement plan, the requirement to withhold tax from the distribution if it isn't paid directly to a traditional IRA or another eligible retirement plan. So if you're going to take a distribution, then they could withhold on it, kind of like you would on a W-2, because you're going to say, hey, I'm going to pay taxes on it. I know I'm going to pay taxes on it. I want you to take some of it out now so I don't have to pay penalties possibly and taxes at the end of the year when I file the 1040. Back to the text. The tax treatment of any part of the distribution that you roll over to a traditional IRA or another eligible retirement plan within 60 days after you receive the distribution. Other qualified retirement plan rules, if they apply, include those for lump sum distributions, alternate payees, and cash or deferred arrangements. How the plan receiving the distribution differs from the plan making the distribution in its restrictions and tax consequences. The plan administrator must provide you with this written explanation no later than 90 days and no later than 30 days from the distribution is made. However, you can choose to have a distribution made less than 30 days after the explanation is provided as long as both the following requirements are met. You are given a 30 days after the notice is provided to consider whether you want to elect a direct rollover. You are given information that clearly states that you have this 30-day period to make the decision. Contact the plan administrator if you have any questions regarding this information. Withdrawing requirements. Generally, if an eligible rollover distribution is paid directly to you, the payer must withhold 20% of it. So notice that's going to be the type of withholding, kind of like a W-2 type withholding. Why are they withholding? This means that they're going to give it to you, but they're going to take some of it. They're going to keep some of it. Why? Typically because they're going to pay it. They're going to pay it to the IRS similarly as a W-2. When you earn money, you earn more money than you actually get because they take some of it from you, but it's not the company's fault. They took it from you to pay the IRS, to pay your taxes for you, that the IRS compels them to withhold and take from the paycheck. Similar type of process here. This applies even if you plan to roll over the distribution to a traditional IRA. You can avoid withholdings by choosing the direct rollover option. So, and that would probably be a way to go. If you can do the direct rollover option and make it as seamless as possible, then that might be the easier thing to do if possible. Discuss later. Exceptions. The payer doesn't have to withhold from the eligible rollover distribution paid to you if either of the following conditions apply. The distribution and all previous eligible rollover distributions you received during your tax year from the same plan or at the payer's option from all your employer plans total less than $200. So there's going to be a dollar limitation. And to consider this rule, you might think, well, why would this be the case? And it's just like the W-2 withholdings, right? The W-2 withholdings, if I'm an employee and the employer paid me money, then the IRS has a lot, once I have the money, the IRS has a lot less leverage to influence individual employees than they do the company who makes a lot more money. They got a lot more leverage on the company. So they want to be able to use the leverage on the company to make sure that the employees pay the taxes. So they're going to say, hey, if you want this deduction for the employees, then you've got to comply with these requirements, because once the employee has the money, we're less confident that they're going to report it and give us it. We want you to report it on the employer side. So they're going to require the withholding to actually take the money from the employee before the employee gets their hands on it and then pay it. So you can see that that's going to be the same case if it's going to be a distribution, typically from a retirement plan that is managed by the employer. The IRS is going to say, hey, we'd rather have you, check, and we want you to double check and make sure the withholdings are done and report to us how much you're giving them with a 1099 and whatnot. And they want that to happen. Now, if it's below a certain dollar amount, you can see why the IRS would say, maybe, that's too low for us to worry too much about. So that's kind of the gist of why the law might be set up in this way, just to get some context of it. Back to the text. The distribution consists solely of employer securities plus cash of $200 or less in lieu of fractional shares. Caution. The amount withheld is part of the distribution. If you roll over less than the full amount of the distribution, you may have to include in your income the amount you didn't roll over. However, you can make up the amount withheld from the funds from other sources. Other withholding rules. The 20% withholding requirement doesn't apply to distributions that aren't eligible for rollover distributions. However, other withholding rules apply to these distributions. The rules that apply depend on whether the distribution is a periodic distribution or a non-periodic distribution. For either of these types of distributions, you can still choose not to have tax withheld. For more information, you can see publication 575. Go to the IRS website, type in pub or publication 575. Direct rollover option. Your employer's qualified plan must give you the option to have any part of the eligible rollover distribution paid directly to a traditional IRA. The plan isn't required to give you this option if your eligible rollover distributions are accepted to total less than $200 for the year. So we have the direct rollover option. This could be a good option to go with. Withholding. If you choose the direct rollover option, no tax is withheld from any part of the designated distribution that is directly paid to the trustee of the traditional IRA. So note, you can consider the situation here. We have the one retirement account managed by the employee in some format by the employer, and then we're going to another IRA, and this is us, the taxpayer. Now, if you're the IRS, you're saying, hey, if the employer takes the money out of their retirement account and gives it to the taxpayer, then the IRS is a bit skeptical about that, right? The IRS is going to say, I want withholdings on it. If you can do that, employer, otherwise we're going to penalize you and we're going to not let you have the deduction and whatnot, right? But if the money goes directly from one plan to the other and the taxpayer doesn't get their hands on it and it's still always under the umbrella of the IRA, then, or some type of retirement account, you can see how the IRS would be a little bit less concerned with that, because now it went directly, the money, you can follow the money. It went from here to there. It's under the umbrella of someone that they can pressure to manage and give them the information on it in terms of the employer and the new financial institution, which of course is also under, has a lot of pressure to make sure that to follow the reporting kind of regulations. And the taxpayer, which the IRS doesn't have as much control over pressure in, is not getting the money, not handling the money. So in that case, it might be the best way to go, just to keep everything smooth and happy, to go directly over and then the transfers is nice and clean, and you may not have to worry then, of course, about the withholding and the 20% withholding. Choosing an option. Table 1.5 may help you decide which distribution option to choose. Carefully compare the effects of each option. So here's the option. We won't go over each of them again, but you can take a look at this table as a recap of those options. In this presentation, we will take a look at a rollover chart to help us consider the types of rollovers. This information can be found in publication 590A. So what we have here is a chart. We got the from, so roll from, and roll to. So we can consider this. We're taking it from basically some type of retirement type of account, and we're putting it into some other type of retirement account and seeing if we can do so. So this is just kind of a general overview type of chart, giving us a bird's eye view, in essence, a distance view of this item. So we have the Roth IRA. So if it's going from the Roth IRA, and notice we'll talk more about Roth IRAs in later presentations. We've been considering here more of a traditional type of IRA. Roth is going to be more of the newer type of IRA, or more unusual, different type of characteristics. It's not better or worse per se, but it just has different characteristics. We'll talk more about them later. So if it goes from a Roth IRA, can it go into a Roth IRA? Typically, yes. And so, this is a general table. And so we've got the Roth IRA. Can it go to a traditional IRA? Typically, no. Why? Because those two are different. We'll talk about the difference between them, but you can imagine the situation, of course, that we're basically saying, if you have the same kind of IRA, once it's in the IRA, then a lot of the retirement plans are much the same. They're either treated kind of like a Roth, or they're treated kind of like a traditional at that point in time. So once they're in the IRA, you would think that you can transfer it over to another IRA that treats the investments once there similarly. And the Roth and the traditional, the Roth and most type of retirement plans are different in nature between the idea of the distribution and how it's going to be handled. So normally you would think, yeah, that makes sense. You can't go from a Roth to a traditional normally. So if we got a Roth IRA to a simple IRA, again, those are two different type of treatments typically. So not usually. A Roth IRA to a SEP IRA, pretty different normally. A Roth IRA to a 457B plan, which is normally from like a government type of plan. No, because again, the 457 is similar to a traditional IRA once it's in there in terms of how it's treated once the money's in there. A Roth to a qualified plan, no. Roth to a 403B plan, no. And again, 403B is another code section for basically plans from a government, kind of like a 401k type of plan if you're a government, some type of government plan, which again, it's more like a traditional IRA than a Roth, therefore no. And then a Roth to a designated Roth account, a 401k, 403b, or 457b. We're saying no. And then we have the traditional IRA, the one that we've been considering here more, which is more like normal. It's traditional. It's the one that it's similar to a lot of these types of accounts. So you would think that, yeah, you could do that for a lot of them. So let's go through these. We're going to say the traditional to the Roth, yes, but you want to be careful on that one. That's one where you would think that you couldn't do that. You would think, well, why? Because they're different. So they're typically those two are different. So this one, you want to look into that one because there might be tax treatments that we might want to try to do that other than just rolling over a retirement account in order to manage it differently. So we'll talk more about that later. Traditional IRA to a traditional IRA. Yeah, well, that makes sense, right? Traditional IRA to a traditional IRA to a simple IRA. We're going to say yes. After 2 years, and again, this is a general table, but we'll say yes here in general, and that would kind of make sense because it's a kind of traditional IRA. Once it's in the IRA, then it's treated much the same. Traditional IRA to a SEP IRA, we're going to say yes. Traditional IRA to a governmental 457. Again, that's kind of like, you could think kind of like a 401, kind of like a retirement plan. for a government agency, it acts similar to an IRA, so that makes sense that it would be yes, traditional to a qualified plan, yes, traditional to a 403B plan, yes, traditional to a designated Roth account. And again, this is a little bit different, a little bit unusual. A designated Roth account, a little bit unusual for a company to have a 401k, 403B, a 457 with a designated Roth account. So they're saying no here. And then we have a simple IRA to a Roth. So now we have the simple, which again is kind of like an IRA that's going to be set up by a company, usually a small business, and it's going to be similar to an IRA, but set up to give benefits for a company or a small business. So a simple IRA, can you take that to a Roth? Again, yes, but that seems a little bit unusual. So that's kind of like a weird case. Simple to a traditional IRA, yeah, that would make most sense normally. Again, this is a general table, could be, more nuance to these rules here, but a simple IRA to a simple, well, that would make sense that you should be able to do that. A simple to a SEP IRA, yeah, they're similar. Simple to a government 457, yeah, because the 457 is similar to an IRA in the treatment once it's in there. A simple to a qualified plan, yes. Simple to a 403B, yes. Again, 403B similar to kind of like a normal retirement type plan for a government. And then simple to the designated Roth account, no. And then a SEP, again, another kind of simplified plan, different characteristics, but once it's in the SEP IRA, it's treated similar to a traditional type of IRA typically. So you would think it would be able to coincide with other traditional type of retirement account setups. So a Roth, yes, again, that's unusual. That's like the weird thing. But traditional to a SEP IRA to a traditional, yeah, that would make sense. A SEP IRA to a simple, can you roll over that? Yeah, that would make sense. A SEP IRA to a SEP IRA, yeah, that would make sense. SEP to a government, yeah. SEP to a qualified plan, SEP to a 403B, yeah, and then no to the designated. And then we have the qualified, and then we have the government 457. And again, that's kind of like a retirement type plan that's similar to a 401k, you would think, or something like that, or a retirement plan for a government. So it's similar. So you would think that, yeah, you can roll that over. You have the similar kind of restrictions once the money's in it. They're named differently. Why? Because the distribution to them a lot of times is what's different. So yeah, you can, now again, can you roll that into a Roth? It says yes, that's a kind of, you would think that's kind of weird, but, and then the government to a traditional, we're going to say yeah, to a simple, yes, to a SEP, yes, to a government, yes, to a qualified plan, yes, 403B, yes, and designated, yes, and that's a bit. And then we got the qualified plan, similar kind of situation, we're going to say yes to the Roth, which is a little bit unusual. You would make sense to go here, as we've seen in the past, because this kind of coincides with what we've been discussing through. And then the 403B, again, that's kind of like another type of retirement plan, acts similar to an IRA once the money's in it. So you would think that would follow the similar pattern. Yes for a Roth, which is kind of funny, but yes to the traditional, that makes sense. Yes to the simple, that makes sense. Yes to the SEP, yeah. The government plan, yeah. The qualified plan, the 403B, that would make sense, and yes here. And then the designated Roth account, again, this is kind of the funny one. It's going to be yes to the Roth, no to all these because it's different than all those. That's kind of a, and then yes to the designated Roth. That's, again, probably not as common, a little bit unusual down here. But you can get some sense, some idea of the relationship between these different types of plans. They look confusing because you got all these different kind of plans, the way they're set up. Note they are all different, but a lot of times they're different with regards to the distribution, how the money's going to go into it, whether the employer has some vesting rules, how long someone has to be there to put the money into it, how much they can put into it, the limitations on how much they can put in, whether or not the employer is going to put money into it. However, once the money's in there, it's treated much the same for tax purposes. It sits there. You can't take it out. It's restricted under the same kind of restrictions. If you take it out, you're going to get penalized unless you take it out under certain conditions, and then they require you to take it out at some point in time so they can take some of it at the distribution point. So once it's in there, they're similar in nature. So when you consider the differences between all of these types of plans, you're often considering how much benefit can I get on the distribution or the contribution to the plan. How much can I get when I put the money into the plan, and those do differ substantially. In this presentation, we will discuss transfers incident to divorce with relation to traditional IRAs. This information can be found in publication 590A. Transfers incident to divorce. If an interest in a traditional IRA is transferred from your spouse or former spouse to you by a divorce or separate maintenance decree or a written document related to such a decree, the interest in the IRA, starting from the date of the transfer, is treated as your IRA. The transfer is tax-free. For information about transfer of interest in employer plans, see distributions under divorce or similar proceedings, alternate payees under rollover from employer's plan into an IRA earlier. So in this case, of course, we have a situation where we have a divorce, and typically if we have the divorce happening, we have, of course, the tax seeing, the IRS or the tax code seeing the two people as one in terms of reporting the taxes, because they have the one tax return and they're going to be reporting on one tax return. Of course, in the incident of divorce from a tax perspective, they're going to be separating their assets and then the reporting of the income on them. And the IRA, what's going to happen to the IRA, then one of the questions, what happens with the IRA if we have the divorce? Well, typically in general, and this is just in general, you can think of the divorce, of course, when they're married, that all the property is basically together. There's different type of rules for community property rules and whatnot for what type of property is in a marriage. But you could think of it, of course, just in marriage, that the IRS sees them as the property being in one lump sum and the interest in it being considered in that fashion. Now, dividends and interest typically are not something that are going to be taxable within the divorce, within the IRA, because they're going to be accumulating upwards in a traditional IRA and then taxed upon distribution. When there's a separation, then the question is, they're separating the assets. And what if they wanted to separate the IRA or apply the IRA out one way or the other in the concept of the divorce? Well, typically, you would think then that because it's part of the divorce agreement, that you can do that without having any taxes, without having a distribution. In other words, if the IRA was under the name of one spouse and in the divorce agreement, it was to go to the other spouse, you would think then generally that because the IRS sees, the taxpayers as one basically individual now being split in accordance with the agreement that they make, that wouldn't be a taxable event. And then you can basically recharacterize the IRA or assume the IRA to whoever is now claiming the IRA in accordance with whatever the divorce was. That you would think would be basically the general rule within the divorce. And then once you have the IRA set up, it would act similar to another type of IRA account. And once the distributions were actually taken out, that's when you would have to pay taxes on it. So the splitting up of the IRA without the actual distribution happening, in other words, shouldn't, in most cases, trigger a distribution that would then be taxable. It's just going to be part of the divorce agreement, splitting up the assets. And then once that has been done, you would think that the assets would be treated in a similar fashion as another type of retirement account. Back to the text. Transfer methods. There are two commonly used methods of transferring IRA assets to a spouse or former spouse. The methods are changing the name on the IRA and making a direct transfer of IRA assets. So notice, again, if you think this from the IRS standpoint, you say, well, we've got this one IRA and we want to make it go from one spouse to the other spouse just in relation to the divorce agreement, because it's in the name of possibly one spouse and we need to make it in the name of the other spouse or something like that, or in both names and we need to make it in one name or something like that. Well, if the IRS is saying, hey, I know that this account is being regulated by the financial institution, and and I have pressure over the financial institution, I'm okay with it being there. If the financial institution just changes the name and regulations are all in accordance from one account to another in accordance with the divorce, then that's fine, right? What they're worried, of course, if you take the money out, then that's when the IRS is going to be kind of sketchy. So the IRS, you could imagine them saying, okay, you just changed the name. That would be a pretty straightforward way to make that transfer. And then if you make a direct transfer of IRA assets, again, if it goes directly from one IRA to another, and doesn't go to the taxpayer, the money doesn't get distributed to the taxpayer in the meantime, then that would be a pretty straightforward way to go as well. And so those would be the transfer methods. Changing the name on the IRA. If all the assets are to be transferred, you can make the transfer by changing the name on the IRA from your name to the name of your spouse or former spouse. That would be the most straightforward way to go. You just say, hey, it's the same thing. We're going to change, the name on the account, and that's it. Now, of course, if you don't want to be in that same financial institution and you want to put your money into a different type of IRA account, then you may want to do that. I mean, you could transfer and change the name and then make the transfer after you have control over it, or choose another method. The direct transfer. Under this method, you direct the trustee of the traditional IRA to transfer the affected assets directly to the trustee of the new or existing traditional IRA set up in the same name of the spouse in the same name of your spouse or former spouse. If your spouse or former spouse is allowed to keep his or her portion of the IRA assets in your existing IRA, you can direct the trustee or transfer the assets you are permitted to keep directly in a new or existing traditional IRA set up in your name. The name on the IRA containing your spouse's or former spouse's portion of the assets would then be changed to show his or her ownership. Caution. If the transfer results in a change in the basis of the traditional IRA of either spouse, both spouses must file Form 8606 and follow the directions in the instructions for that form. In this presentation, we will discuss converting from any traditional IRA into a Roth IRA. This information can be found in publication 590A. So this is kind of that unusual type of situation. We're talking about a traditional IRA to a Roth IRA. You would think on its face, you would say that shouldn't happen. That's kind of unusual. These are two different types of IRA accounts. As we've discussed in prior presentations, other types of retirement accounts are very similar once the money is in it. When you think of a traditional IRA versus other type of retirement accounts that might be set up in employer type of retirement accounts. The Roth, though, is a little bit different. The Roth is designed almost in reverse, meaning you don't get the benefit as we put the money into the Roth. We'll discuss more of the characteristics of the Roth, but the idea is that we're not getting the benefit when we put the money in, and then when we take the money out, we're not going to be taxed on it at the taking the money out point. So it's kind of like the reverse type of situation. So you would think that the two are not the same in that characteristics and the characteristics of them. So the transfer between them is a little bit unusual and could have tax planning consequences outside of just wanting to manage basically your assets in different types of financial institutions, which is usually often the case when we roll over from one traditional retirement account to another. In other words, we often, if we're leaving an employer or if we want to have our financial investments managed in some other financial institution, that's often what's going to trigger us from rolling over from one traditional type of retirement account to another. With changing from a traditional IRA to a Roth IRA, we might have some other kind of incentives to do so that are more tax planning incentives rather than just managing of the financial assets incentives. Back to the text. Converting from any traditional IRA into a Roth IRA. Allowable conversions. You can withdraw all or part of the assets from a traditional IRA and reinvest them within 60 days into a Roth IRA. The amount that you withdraw and timely convert to the Roth IRA is called a conversion contribution. If properly and timely rolled over, the 10% additional tax on early distribution won't apply. However, a part or all of the distribution from your traditional IRA may be included in gross income and subject to ordinary income tax. So note it's a little bit unusual here. We're going to pull the money out. Let's read through that one more time. We'll discuss a little bit of the unusualness as we go. You can withdraw all or part of the assets from your traditional IRA and reinvest them within 60 days into the Roth IRA. Notice that's similar to how we might set things up if we were to take money out of an IRA and put it into another type of IRA, which would be kind of a rollover type of situation. The amount that you withdraw and timely convert to a Roth IRA is called a conversion contribution. So now, of course, what's happening is we're taking the money out and we're contributing it back in, but we're not contributing it back to a normal IRA. We're changing the IRA type, so that's the name, conversion contribution. If properly and timely rolled over, the 10% additional tax on early distribution won't apply. That's going to be our point. That's what we want to do. We're trying to recharacterize in some way our traditional IRA to a Roth IRA, and we don't. And the only way to do that is to take the money out early and reinvest it. But if we do that, we're subject to a 10% penalty typically, and we don't want to be subject to a 10% penalty. So that means that if we follow this rule, then, and that's going to be the major benefit, right? We're going to take the money out and try to put it into a Roth IRA to get the tax benefit of a Roth IRA versus a traditional. And notice, why might we do that? Just realize that in the point of retirement, if all of our money is in a traditional IRA, when we take the money out, it's all going to be basically taxable at that time because we have to pay taxes when it comes out. So if we're living on $100,000 at the point of retirement, it's all going to come out of some type of retirement account. We're going to have to pay taxes on the whole $100,000. But if half of it came out of a different type of account, like maybe a Roth account, then we can be living off $100,000 and only paying taxes on $50,000, which would be nice, right? We pay less taxes that way. So there's tax reasons why we might want to recharacterize when we think towards how we're going to pull the money out, distributions in the time of retirement. So in any case, when we recharacterize, we don't want to pay penalties on it. So we want to be able to conform with this, and we might be able to remove that 10% penalties. However, a part or all of the distribution from your traditional IRA may be included in gross income. So notice that you still may have to include the distribution in gross income, which means you'd pay taxes on it. And you might say, well, why would I want to pay taxes? Because you're trying to recharacterize possibly the information now into a Roth, because that could help you later down in the road when you start to pull more money out. So obviously our goal here is to try to pay some taxes in possibly a lower tax bracket, and then when we pull the money out, possibly we're not taxed on it. So at a later point in time, if we were in a higher tax bracket, we'd rather basically pay taxes in the lower tax bracket if that's applicable, and subject to ordinary income tax. All right, back to the text. You must roll over into the Roth the same property you receive from the traditional IRA. You can roll over part or of the withdrawal into a Roth IRA and keep the rest of it. The amount you keep will generally be taxable except for the part that is a return on non-taxable contribution and may be subject to the 10% additional tax on early distributions. So of course, if we take money out of the traditional and we only put part of it back into the Roth IRA, well then the part that we keep and we didn't put back into the Roth IRA is going to be a distribution. Normally kind of distribution typically could be subject to a 10% penalty if it is subject to a 10% penalty given an early distribution. See when you can withdraw and use assets later. For more information on distributions from traditional IRAs and early distributions in publication 590B. For more information on the tax on early distributions. Periodic distributions. If you started taking substantially equal periodic payments from a traditional IRA, you can convert the amounts in the traditional IRA to a Roth IRA and then continue the periodic payments. The 10% additional tax on early distributions won't apply even if the distributions aren't qualified distributions, as long as they are part of a series of substantially equal periodic payments. Required distributions. You can't convert amounts that must be distributed from your traditional IRA for a particular year, including calendar year in which you reach age 70 and a half, under the required distributions discussed in publication 590B. So again, you can imagine this situation. You have the IRA. I've got an IRA. We're over 70 and a half, and we don't need the money. We don't want to pull the money out, but they give us the money anyways because the IRS is saying, hey, we've given you a deferral all this time. We want you to take the money out. You have to take the money out because we want some of it. And that was the deal. And they're not going to let you take the money out because they're forcing you to take it out. They're not going to force you to take it out so they can take some and then allow you to put it into a Roth rollover type of distribution typically. So, and you might say, well, why not? Because if I rolled it over, I may still have to pay taxes on on it, but note that the required distribution, typically you can't roll that over and call it basically a rollover into another type of retirement account. Or in this case, a conversion. Can't call it a conversion into the other type of account. So back to the text. So if it's a required distribution, then it's, a required distribution typically. Income. You must include in your gross income distributions for a traditional IRA that you would have had to include the income if you hadn't converted them into a Roth IRA. These amounts are normally included in income on your return for the year that you converted them from a traditional IRA to a Roth IRA. You don't include in gross income any part of a distribution from a traditional IRA that is a return from your basis, as discussed under our distributions taxable in publication 590B. So note that, if we got the money, part of it might be part of the cost. The only part that's going to be taxable when we put money into a normal IRA, and we've discussed this a couple times, is if we got the benefit. If we got a benefit, a tax deduction when we put the money in. That means that when we take this money out, we're going to have to pay taxes on it because it was a deferral. We might have money in a retirement account, like an IRA type of account, where we didn't get the benefit at the front, and therefore the distribution of it may not be taxable. We'd have to track that. That's something that should be tracked by the financial institution and be able to track that as we go. In this presentation, we will discuss the question of when can you withdraw or use assets with regard to a traditional IRA. And of course, this is going to be an important question because when we think about putting money into the IRA account, we're typically thinking about that in terms of tax planning. We're saying, hey, I'm going to put $5,500 into the IRA account. I'm only going to get possibly after the tax savings on that might be closer to like $600. I got to put $5,500 in to save something like maybe $600 or $700 or something, depending on the tax rate. Then what happens to this money? When do I get to use it? Because now it's going to be in the IRA, and part of the problem with that, it's still our account when we put it into the IRA. It's still ours. We're not giving it to anybody, but it's locked in some ways. It's restricted from us. If we take it out, we get penalized. So the question then is, well, what happens with it, and when do I get the money back? When do I get to use my money according to that? So that's what we'll take a look at now. You can withdraw and use your traditional IRA assets at any time. However, a 10% additional tax generally applies if you withdraw or use IRA assets before you are age 59 and a half. So that's going to be the general rule. That's the point. That's the deal that the government is giving us. We'll give you a deduction now if you put money into an investment account, not because there's something special about the investment account, but because we want you to lock it into that investment account and commit to it being there. And how do you do that? Well, the IRS puts in a setup so that if you take it out, you get penalized on it. So you can't take it out typically until the point of retirement, which they're defining at 59 and a half at this point. Now, there are other exceptions that might help. And how do they make you? So it's still yours. So if you go into it and say, I want to take my money out, you can do so, but you're going to probably end up paying a 10% tax on it or penalty and include it in income at the point in time that's distributed. It makes sense that it's included in income because that's the deal. You didn't include it in income here. We didn't include it when we put the money in. Now, when we take it out, we're going to include it in income. We get to defer the income taxes, not remove them entirely. That's the deal. But we also have the penalty on it because part of the deal was that you don't take it out until retirement. That's why the benefit is there in the first place, and therefore we can always take it out. It's there in case of emergency, but it's going to cost to do it because we'll have to pay taxes on it, and we may have to pay a penalty on it. You generally can make a tax-free withdrawal or contributions if you do it before the due date for filing your tax return for the year in which you made them. This means that even if you are under age 59 and a half, the 10% additional tax may not apply. These withdrawals are explained later. So we'll go into more detail on these items in a bit. In this presentation, we will discuss a situation of contributions returned before due date of return. This information can be found in publication 590A. If you made IRA contributions in 2018, you can withdraw them tax-free by the due date of your return. If you have an extension of time to file your return, you can withdraw them tax-free by the extended due date. You can do this if, for each contribution you withdraw, both of the following conditions apply. You didn't take a deduction for the contribution. So we have a situation, we put money in, we didn't take the deduction for the contribution. That's the point of putting it in there, and we haven't yet done that at this point in time. 2, or second item, you withdraw any interest or other income earned on the contribution. You can take into account any loss on the contribution while it was in the IRA when calculating the amount that must be withdrawn. If there was a loss, the net income earned on the contribution may be a negative amount. Note, if you timely filed your 2018 tax return without withdrawing a contribution that you made in 2018, you can still have the contribution returned to you within 6 months of the due date of your 2018 tax return, excluding extensions. If you do, file an amended return with filed pursuant to Section 301-91002 written at the top. Report any related earnings on the amended return and include an explanation of the withdrawal. Make any other necessary changes on the amended return. For example, if you reported the contribution as excess contributions on your original return, include on amended Form 5329 reflecting that the withdrawal contributions are no longer treated as having been contributed. So we can, in essence, obviously if we timely filed, then we have the withdrawal, we can amend the return and then within the regulations, within the time period given, and then go through the process and make those changes within the amended return. Example, on May 2nd, 2019, when her IRA is worth $4,800, Kathy makes a $1,600 regular contribution to her IRA. Kathy requests that $400 of the May 2nd, 2019 contribution be returned to her. So she put in $1,600, and then she wants a return of $400 by May 2nd of 2019. So then we got on February 2nd, 2020, when the IRA is worth $7,600, the IRA trustee distributes to Kathy the $400 plus net income attributable to the contribution. So she had the $400 plus there's net income for that $400 that is going to be applied as well. No other contributions have been made to the IRA for 2019, and no distributions have been made. The adjusted opening balance is $6,400, which is the $4,800 plus the $1,600, and the adjusted closing balance of $7,600. The net income due to May 2nd, 2019 contribution is $75, which was the $400 times the $7,600 minus the $6,400 divided by the $6,400. Therefore, the total to be distributed on February 2nd, 2020 is the $475, because basically they're giving the amount of earnings related to that $400 back out. This is shown in Worksheet 1.4, example illustrated. Last in, first out rule. If you made more than one regular contribution for the year, your last contribution is considered to be the one that is returned to you first. So notice when you're thinking about the contributions, you could think of, well, you know, which contribution am I getting back? Am I getting an earlier contribution or a later? We consider the last in, the last contribution made, to be the first one that would be distributed out if that were the case. Earnings includable in income. You must include in income any earnings on the contributions you withdraw. Include the earnings in income for the year in which you made the contributions, not the year in which you withdrew them. So if we take the money out and we take it in the timely fashion, just like the example we had some income there related to it. And now because it's not in the IRA anymore, we have to include that income in income, pay taxes on it. Caution, generally except for any part of a withdrawal that is a return of non-deductible contributions basis, any withdrawal of your contribution after the due date or extended due date of your return will be treated as a taxable distribution. Excess contributions can also be recovered tax-free as discussed under what acts result in penalties or additional taxes later. Early distribution tax. The 10% additional tax on distributions made before you reach age 59 and a half doesn't apply to these tax-free withdrawals of your contributions. However, the distribution of the interest or other income must be reported on Form 5329, and unless distributions qualify as an exception to the age 59 and a half rule, it will be subject to this tax. See early distributions under what acts result in penalties or additional taxes in publication 590B. In this presentation, we will discuss prohibited transactions with regard to traditional IRAs. This information can be found in publication 590A. So as we consider the IRAs, note that we have a benefit, we have a deal in essence with the IRS saying that we're going to get some preferential tax treatment. Typically that tax treatment that is preferential is that we don't include in income the amount that we distribute, or we get a deduction for it. But the IRS says that you have to have it in the retirement account, and you have to basically hold on to it until retirement. At that point in time, when you pull it out, we get to tax you at that point in time. That's in essence the deal. Now, if we break that deal in some way, then we have some problems and we have to deal with that in some way. And the question, of course, is, well, what are those things that are prohibited, and what kind of penalties are related to them? Back to the text. The tax advantages of using traditional IRAs for retirement savings can be offset by additional taxes and penalties if you don't follow the rules. There are additions to the regular tax for using your IRA funds in prohibited transactions. So if you use the IRA funds for prohibited transactions, then it could be subject to problems here. So there are also additional taxes for the following activities. So there could be additional taxes, in essence, additional tax kind of you can think of as a penalty for these types of transactions. Investing in collectibles. So collectible items, if the investment is in some type of collectible items like, stamps or whatever the collectible item might be. Making excess contributions. Taking early distributions, see publication 590B, allowing excess amounts to accumulate, failing to take required distributions. So remember, we have to, at some point in time, take the money out in a required distribution. The IRS wants it to be saved for retirement, not to be saved basically indefinitely and never, in essence, never be taxed on. And having unrelated business income. There are penalties for overstating the amount of non-deductible contributions and failure to file Form 8606 if required. So you can imagine one of the problems the IRS is going to have with tracking this information is that if we put money in and we put more money, say we got a deduction of $5,500 and we put more money in than that, or if we put $5,500 in and we were only allowed a deduction of $3,000 or something, then we would have part of it that we didn't get. In essence, if we have any money in there that we didn't get the deduction from, then it's money that is part of the cost basis, and when we withdraw it out, it's not going to be taxable when we draw it out. So note the general rule is you don't pay taxes when you put it in, you get a deduction, then when you take it out, you pay taxes on it. But what if when you put it in, you didn't get the benefit? You paid taxes on it because you didn't qualify for the deduction. Well, then when you take it out, you don't have to typically pay taxes on that portion of it. And you can see what people, taxpayers might be incentivized to do then is to report more money in the IRA that they didn't get a tax benefit on, and misreport that information in essence. And there's of course going to be penalties for that, because that's an attempt to misguide what's really going on, have money in the IRA and characterize it basically as money that's not going to be taxed upon distribution when in essence it should be. So you could be subject to penalties for that. This chapter discusses those acts that you should avoid and the additional taxes and other costs, including loss of IRA status, that apply if you don't avoid those acts. In this presentation, we will discuss exempt transactions with relation to traditional IRAs. This information can be found in publication 590A. The following two types of transactions aren't prohibited transactions if they meet the requirements that follow, meaning they're not prohibited and therefore hopefully not subject to the penalties of those prohibited transactions. First item, payments of cash, property, or other consideration by the sponsor of your traditional IRA to you or members of your family. Your receipt of services at reduced or no cost from the bank where your traditional IRA is established or maintained. Payments of cash, property, or other consideration. Even if a sponsor makes payments to you or your family, there is no prohibited transaction if all three of the following requirements are met. 1. The payments are for establishing a traditional IRA or for making additional contributions to it. 2. Your IRA is established solely to benefit you, your spouse, and your spouse's beneficiary. 3. During the year, the total fair market value of the payments you receive isn't more than A. $10 for an IRA deposit of less than $5,000 or B. $20 for IRA deposits of $5,000 or more. If the consideration is group life insurance, requirements 1 and 3 don't apply if no more than $5,000 of the face value of the insurance is based on a dollar-for-dollar basis on the assets in your IRA. Services received at reduced or no cost. Even if a sponsor provides services at reduced cost or no cost, there's no prohibited transaction if all the following requirements are met. The traditional IRA qualifying you to receive the services is established and maintained for the benefit of you, your spouse, and your spouse's beneficiaries. The bank itself can legally offer the services. The services are provided in the ordinary course of business by the bank or the bank affiliate to customers who qualify but don't maintain an IRA or co-op plan. The determination for the traditional IRA of who qualifies for these services is based on an IRA or co-op plan deposit balance equal to the lowest qualifying balance for any other type of account. The rate of return on the traditional IRA investment that qualifies isn't less than the return on identical investments that could have been made at the same time at the same branch for the bank by a customer who isn't eligible for or doesn't receive these services. In this presentation, we will discuss investment in collectibles with regard to the traditional IRA. This information can be found in publication 590A. If your traditional IRA invests in collectibles, the amount invested is considered distributed to you in the year invested. You may have to pay a 10% additional tax on early distributions discussed in publication 590B. So you can consider this and you can think about this. Well, why would that be? If you can invest in many different things. Note what we have here is a retirement type of account, and the retirement type of account goal is to save us on taxes so that we're incentivized to put money away for retirement. So the government's going to give us a benefit for us to do that. Now, normally we put money into some type of account that we would think of to save it. And that would be like a savings account at a bank or possibly investments, stocks, and bonds that would go up in value that we don't touch until the end of the time period, and then we take the money out. But you can think about investing in many different things. You can say, I'm going to invest in all types of different things, and I can choose whatever I want to invest in as long as it's within the umbrella of the IRA. Well, I can choose whatever type. It doesn't give you the IRA. The fact that it's under the umbrella of the IRA isn't designed to really restrict the decisions on the type of investments that you want to make. The investment is just going to restrict taking the money out. The goal is to make sure that it's in investments so that it's going to be saving for retirement. So you can imagine someone going, well, I'm going to invest in like really fancy cars or something and like that because I think they're going to go up in value, and they very well might go up in value. So I'm going to invest in Picasso paintings or something like that. And that means they're going to go up, or I'm going to, so you can imagine these types of investments, but you can also imagine the IRS being skeptical of them. One, because the risk is probably fairly high that those items that go up in value, and two, because it seems kind of fun. And right, it's another one of those things where the IRS doesn't like to incentivize things that might be kind of fun, or it also seems like you're going to be getting engagement or enjoyment of the process now instead of the main goal being to save for retirement. So if you put money into collectibles, even though they might go up in value, the IRS is probably pretty strongly worried or thinking or that the main objective might be for current consumption to have the collectibles possibly, rather than a real plan for retirement could be the justification. But in any case, they're skeptical of collectibles, so you gotta be careful of those. Any amount that were considered to be distributed when the investment in the collectible was made and which were included in your income at that type aren't included in your income when the collectible is actually distributed from the IRA. So in other words, basically you may lose the fact it looks like a distribution. It may be caused to be a distribution at the point in time that the IRA account then invests in a collectible. It should be then income at that point in time, possibly a distribution subject to the 10% penalty. So then, of course, once you get distributed that collectible later at the point of retirement, then if it was already subject to the penalty, you would think it would not be subject to the penalty again at the point of distribution. So what are collectibles? These include artwork, rugs. So rugs is not one I was quite aware. Artwork would make sense, right? You're collecting Picasso paintings for retirement. Seems odd. Seems a little odd, but could work. But the IRS is skeptical of that. Doesn't want that to be done within the IRAs. Antiques, metals, gems, stamps, coins, alcohol beverages. So obviously that's another one you can try to save up on old bottles of wine possibly and say those are and they could happen. They could be a good investment possibly. IRA's not having it. Certain other tangible personal property. Exception. Your IRA can invest in 1/1/2, 1/4, or 1/10 ounce U.S. gold coins or 1 ounce silver coins minted by the Treasury Department. It can also invest in certain platinum coins or certain gold, silver, palladium, and platinum bullion. So in other words, the currency has always been something that we're not supposed to be able to put money in metals. So metals could be a collectible. It was listed as one of the collectible items. Typically, you would think about gold and silver kind of coins and things like that as collectible items that would be collectibles and typically not then qualify. But obviously, gold and silver was at some point a form of currency at some point in time. So there's kind of some overlap, and the IRS could see some conditions or some places where people might be concerned with gold and silver and might want gold and silver as a legitimate kind of investment, especially possibly a concern against devaluation of normal investments or some kind of catastrophe. So they're going to give, this is my interpretation of the reasoning of the code, which might help to understand it a bit more. So that would mean that they're going to allow then an exception for certain metals that typically would be collectibles. So if you're thinking about metals, then you got to be careful about what kind of things qualify and making sure you're within the threshold of qualifications if you're going to be investing in them within an IRA. In this presentation, we will discuss excess contributions with relation to traditional IRAs. This information can be found in publication 590A. Generally, an excess contribution is the amount contributed to your traditional IRA for the year that is more than the smaller of $5,500 or $6,500 if you are age 50 or older, or your taxable compensation for the year. In other words, these are basically the limits that we typically have. What's going to happen if we put in an excess amount of that more than these amounts into the IRA for a given year? The taxable compensation limit applies whether your contributions are deductible or non-deductible. So in other words, it's possible that we could put these limits in and they could be deductible contributions, items that we have here that we're going to deduct on the tax return, that being given our normal situation where we would want to have them be deductible. However, they could have a situation where they're not deductible. And so note here that the taxable compensation limits apply whether your contributions are deductible or non-deductible. Contributions for the year you reach at 70 and a half and any later year are also considered excess contributions. Why? Because at 70 and a half, if you put money into an IRA, you're not supposed to do that. And therefore, you're not supposed to put any money in after that point. And therefore, all of the amount would be considered excess contribution at that point in time. An excess contribution would be the result of your contribution, your spouse's contribution, your employer's contribution, and improper rollover contribution. If your employer makes a contribution on your behalf to a SEP IRA, See Chapter 2 of Publication 5 or 560, Tax on Excess Contributions. So what happens? What if we could only put in, the contribution limit is $5,500 and we put in more? What's going to happen? What's going to be the deal? In general, if excess contributions for a year aren't withdrawn by the due date you returned for the year is due, including extensions, you are subject to a 6% tax. So note that as you put the money in, note if we put more than the $5,500 and we say, oh, there's a limit, and we already put the money into the IRA, well, then the question is, well, what do I do about it? You take the money out, clearly, and obviously if you don't put the amount here, you don't deduct it in some way because it's excess, so you shouldn't have the deduction for any excess contribution. Then you have until the due date of the tax return, including the extension, to make the required correction. And if that does not happen, then there could be subject to the 6% tax. You must pay the 6% tax each year on excess amounts that remain in your traditional IRA at the end of your tax year. So if they're still in the IRA, then you still owe the 6% tax as long as they're still in there. Because what the IRS doesn't want to have happen is to put the excess contributions in there, allow them to accumulate, receive gains on them and whatnot, and then get that deferral of the gains through that process. So the excess contributions, they want you to remove the excess contributions typically. The tax can't be more than 6% of the combined value of all your IRAs as of the end of your tax year. The additional tax is figured on Form 5329. For information on file in Form 5329, you can see reporting additional taxes later. Example, for 2018, Paul Jones is 45 years old and single. His compensation is $31,000 and he contributed $6,000 to his traditional IRA. See, that seems a little high because you would think it would be $5,500. I think it's a little over. So Paul has an excess contribution to his IRA of $500, which is the $6,000 minus the $5,500 limit. The contribution earned $5 interest. Well, it's already in there now, that extra $500, and they earned $5 on it before it was taken out. So now there's income on it to complicate things. $5 interest in 2018 and $6 interest in 2018 before the due date of the return, including extensions. He doesn't withdraw the $500 or the interest it earned by the due date of the return, including extensions. I think this might be 2019, but in any case, interest has been earned. Paul figures his additional tax for 2018 by multiplying the excess contribution $500 shown in Form 5329, line 16 by 0.06, giving him an additional tax liability of $30. He enters the tax on Form 5329, line 17, on Form Schedule 4. So note, again, if you have to do that, then you got to report the added tax. What you want to do, of course, is see if you can withdraw this out. Notice he doesn't withdraw the $500 or the interest it earned by the due date of the return, including extension. So we have the due date of the return, including extension. If you figure that you have more money in the IRA than you're supposed to have in the IRA, then you have a pretty long time to figure that out typically. So you want to pull that out if you can. If you can't, if that's not the case, haven't done so in that time, then you can file the tax on it, the 6% tax. Note that you still typically need to pull it out because that tax could accumulate to the following period as well until the point in time that you take it out generally. So excess contribution withdrawal by due date of return. You won't have to pay the 6% tax if you withdraw an excess contribution made during a tax year and you also withdraw any interest or other income earned on the excess contribution. So you'd have to take out the amount that you put in plus the interest earned on it, and then you're good, and you won't have to pay the tax on it. You must, or the excess tax. You must complete your withdrawal by the date your tax return for that year is due, including the extension. So if this happened, we do have the extension period that we can take care of that and fix it. And note, if this is an issue, because when we file the tax return, if we put $6,000 into the IRA, the tax software, when we go to our tax preparer, will say, or if we're preparing the taxes, we'll typically say, hey, you can only have $5,500, and it could be, and then we'll determine that that's the limit. that that's the limit that we have. It's due to a limit, and if it is, then we can't put more money in. Then and we already put another $6,000 in. Then this amount should be reported correctly on the tax return. So the IRS, from an IRS perspective, if you were the IRS, you'd say, well, you did the right thing on the taxes. You only got the deduction for the $5,500, but you have another $500 that's in the IRA that could be making money, and then you get a tax benefit when it gets distributed, or possibly, depending on how it's reported. And that needs to be taken care of. So you're pretty good on the taxes. The taxes are good. Just fix the problem. What's the problem? You have another $500 that are in an IRA that shouldn't have been put in there, and therefore take it out. So you can see from an IRS perspective, it's not, the taxes should be right. It's just you got to correct what's actually in the account right now, which is a $500 too much. So you got to take it out, and you have by the due date of the return plus the extensions to do that. How to treat withdrawal contributions. Don't include in your gross income an excess contribution that you withdraw from your traditional IRA before your tax return is due if both the following conditions are met. No deduction was allowed for the excess contribution. You withdrew the interest or other income earned on the excess contribution. You can take into account any loss on the contribution while it was in the IRA when calculating the amount that must be withdrawn. If there was a loss, then the net income must be withdrawn may be a negative amount. So if we lost money, if our investments lost money when we put it in there, our $500 that we excess put in there lost money, then we're going to pull out less than we could take that into account. We're going to pull out less than the $500 because we lost money in the stocks and bonds that, or whatever that was invested in. Back to the text. In most cases, the net income must transfer will be determined by your IRA trustee or custodian. So hopefully, as we put the money in, the financial institution, the trustee or custodian, can do this calculation, figure this out for us, and be able to take care of it. If you need to determine the applicable net income you need to withdraw, you can use the same method that was used in Worksheet 1.3. If you timely file your 2018 tax return without withdrawing a contribution that you made in 2018, you can still have the contribution returned to you within 6 months of the due date of your 2018 tax return, excluding extensions. If you do, file an amended return with filed pursuant to Section 301-91002 written at the top. So we'd have to amend our return in order to make the adjustment. Report any related earnings on the amended return and include an explanation of the withdrawal. Make any other necessary changes on the amended return. For example, if you report the contribution as excess contributions on your original return, include the amended Form 5329 reflecting that the withdrawal contributions are no longer treated as having been contributed. So note, you might have a situation, in other words, you put $6,000 in and $500 too much, and then you filed the return, you only deducted the $5,500, which is fine, but then the excess $500 that you put in there in 2018 earned some interest on it. Well, now the IRS says you owe us the taxes on the interest that it earned, and so then we might have to possibly amend the return for the tax on the interest that was earned on the investment that we shouldn't have put in to the IRA. Back to the text. How to treat withdrawal interest or other income. You must include in your gross income the interest or other income that was earned on excess contributions. Report it on your return for the year in which the excess contribution was made. Your withdrawal of interest of or other income may be subject to an additional 10% tax on early distribution discussed in publication 590B. Form 1099-R. You will receive a Form 1099-R indicating the amount of the withdrawal. If the excess contribution was made in a previous tax year, the form will indicate the year in which the earnings are taxable. So typically the institution we have our money in will typically issue then a 1099-R and hopefully indicate with the code, the proper code, to reflect what kind of distribution we have. Here's an example. Maria, age 35, made an excess contribution in 2018 of $1,000, which she withdrew by April 15, 2019, the due date of her return. At the same time, she also withdrew another $50 income that was earned on the $1,000. So the excess contribution of $1,000, but then it earned another $50, which she had to withdraw because it was earnings on the excess contribution. She must include the $50 in her gross income for 2018. So notice we have to include that $50 in the income of 2018. It wasn't included because it earned income in an IRA, which is usually not included until the point of distribution. At that time, you pay taxes, but it shouldn't have been in the IRA, and therefore tax should be paid on any income given the fact that it shouldn't have been in there in the first place. The year in which the excess contribution was made. She must also pay an additional tax of $5, 10% additional tax on early distribution because she isn't yet 59 and a half years old. So she's got that penalty of the 10%. Not too bad because we're only being penalized on the interest that was earned, the $50 on the original investment, but it is what it is. But she doesn't have to report the excess contribution as income or pay 6% excess tax. So she's not subject to the 6% excess that would be applied to the full, $1,000 or $1,050 because she took the money out. So that's good. Maria receives a Form 1099-R showing that the earnings are taxable for 2018. Excess contribution deduction in an earlier year. If you deducted an excess contribution in an earlier year for which the total contributions weren't more than the maximum deductible amount for that year, see the following taxable. You can still remove the excess from your traditional IRA and not exclude it in your gross income. To do this, file a 1040-X, typically an amended type return, for that year and don't deduct the excess contribution on the amended return. Generally, you can file an amended return within 3 years after you file your return or 2 years from the time the tax was paid, whichever is longer. So here's going to be the years, the contribution limit if age 50 or older at the end of the year. So if we have 2013 to 2018, that's that 5,500. 50 or older, it's at that 6,500. That's the contribution limit. If you got 2008 to 2012, it was 5,000 to 6,000. So notice this is one of those items that stick a little bit longer. They leave it there a little bit longer, whereas other types of items in the tax code vary with inflation typically, or the value of money more rapidly. This one has been here since 2013 at the 5,500. And then before that, you can take a look at the table in prior years. Excess due to incorrect rollover information. In this presentation, we will discuss reporting additional taxes with relation to traditional IRAs. This information can be found in Publication 590A. Reporting additional taxes. Generally, you must use Form 5329 to report the tax on excess contributions, early distributions, and excess accumulations. Filing a tax return. If you must file an individual income tax return, complete Form 5329 and attach it to your Form 1040 or Form 1040-NR. Enter the total additional tax due on Schedule 4, Form 1040, line 59, or Form 1040-NR, line 57. So here is our example in our test 1040. We have the simple single individual. We're going to say that this individual earns $30,000, and then we also had the $10,000 that was distributed. And we're going to say, let's imagine that he may be changing jobs or something like that and had $10,000 in an IRA or some type of retirement account. Let's say an IRA. He's going to take the money out and possibly is leaving and says, just give me the money. I just want the money. So if they take the money out and we're not at the age of retirement age, then it's an early distribution. And note, again, the deal is that the IRS says put money in now, and we're going to give you a benefit for that contribution in the case that, or with the agreement of you keeping it in there until the point of retirement, at which point you take it out, we pay taxes then. But if you take it out early, then you still have to pay taxes on it. Why? Because you got a benefit when you put it in. That makes sense. Therefore, we have to increase the income by the $10,000. Not only that, but the code has to disincentivize the early withdrawal. Not just paying tax. They don't see that as enough of a disincentive. They want to actually penalize as well. So we have to include the $10,000 then as money that was taken out. So now we're at $40,000 of income, which is going to increase the amount of tax that we will pay. Also, we're going to pay a penalty on it. So here's our penalty that we have, the $1,000. it's in Schedule 4, new schedule for 2018. This is being calculated on Form 5329. So 5329, additional taxes on qualified plans, including IRAs and other tax-favored accounts. And in essence, we're taking 10% of line 3, the distribution, 10,000, 10% of it, 1,000, that then going to Schedule 4, as we can see here, that then flowing down to line 64, Schedule 4, and then rolling over to the 1040. You can see the normal tax calculation on the 40,000 minus the standard deduction gives us the 28,000 for a single, standard deduction for a single, 12,000. Then the tax being calculated at 3,173, but we also have that 10% that's pulling over from Schedule 4 of the 1,000, so the tax is at 4,173. So note, an early distribution can really not be good. We really don't want that to happen, because if we're not expecting it to be included in income, that's a shock. So now we have 10,000 more income, and that could be a shock, especially if it's a large amount that we are pulling out of a pension plan that's been saving up for some time. Not only that, but the 10% penalty over and above on top of the added tax that we're going to pay on the income could be a shock as well. So if you have a retirement plan and you're moving, or you want to change the retirement plan, or you're changing jobs, be very careful. Don't just take it out without thinking about it, unless you need it for some other type of purpose. It'd be best not to do so if you don't have to. Not filing a tax return. If you don't have to file a tax return, but do have to pay one of the additional tax mentioned earlier, file a completed Form 5329 with the IRS at the time and place you would have filed Form 1040 or Form 1040-NR. Be sure to include your address on page 1 and your signature and date on page 2. Enclose, but don't attach, a check or money order payable to the United States Treasury for the tax you owe as shown on Form 5329. Write your Social Security number on 2018 Form 5329 on the check or money order. Form 5329 not required. You don't have to use Form 5329 if either of the following situations exist. Distribution Code 1, early distribution, is correctly shown on Box 7 of the Form 1040-R. So the distribution codes are going to be the items that are going to tell us what type of distribution we have. So when we have a 1099-R, that's going to be the form that it's going to be given to us by the institution, typically the financial institution that gave us the distribution. We want to make sure that they have the proper code, because that's what's going to tell the IRS what type of treatment we should be reporting and whether or not we pay taxes on it. So note that these are the types of codes, and you can look them up on the IRS website, but if you look at the 1099-R instructions, you'll see the code. So it's going to be code section 1 is early distribution, no known exception. So that code section is telling the IRS, look, it's an early distribution. We don't know of any known exception. And that's what the people paying us, the money that are distributing us, the financial institution, is telling the IRS. And so they know well that we got money and we should be paying taxes on it, plus a 10% penalty given that code that's on the 1099-R typically. Back to the text. If you don't owe any other additional tax on the distribution, multiply the taxable part of the early distribution by 10% and enter the result in Schedule 4. So that's pretty straightforward. It's a 10% penalty. So if they say, hey, it was an early distribution, you have no reason for it, then in essence we owe 10%. Pretty easy to calculate. We'll take the distribution times 10%. That's typically what we owe. Back to the text. Line and plus, obviously we might owe taxes on the amount that we took off, but the penalty is going to be pretty straightforward as the 10%. Back to the text. Line 59, or on Form 1040-NR, line 57. Enter no to the left of the line to indicate that you didn't have to file Form 5329. However, if you owe this tax and also owe any other additional tax on a distribution, don't enter this 10% additional tax directly on your Form 1040 or Form 1040-R. You must file Form 5329 to report your additional taxes. If you rolled over part or all of the distribution from a qualified retirement plan, the part rolled over isn't subject to the tax on early distribution. So if it was a rollover, again, note that what you really want to see happen is that if it's a rollover, then the code section is going to be a rollover code section. And that should indicate that you won't have the tax, right? If I put this into the software and say it was a rollover, then we should remove it from the taxable. Hopefully none of it is taxable, right? Then hopefully it's not going to be taxable. It's going to be an information thing, and we don't have the added tax. And so if it qualifies for a rollover, you want to make sure that the institution that gives you the 1099-R reports it properly as a rollover, as opposed to saying a 1 in the code, which would say that, hey, you owe taxes. That's basically telling the IRS they owe taxes on it, you know, a 10% penalty possibly on it. So just be aware of those, the 1099-R, what that code section will be, and aware of the rules to make sure that you qualify for whatever you can qualify for. If you don't, then you have possibly the penalties, and this is how you report the penalties in the tax return.